are still seeing that investors are sitting on the sidelines of this market.
There has been a shift in sentiment, and you're starting to see some deterioration in some of the key themes.
The equity market has to climb, basically, the traditional wall of worry.
You have an equity market that broadens and rotates a little bit.
As we think about next year, we do like equities. We do like U.S. equities in particular.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks inching back to record highs with optimism fueled by ongoing resilience among U.S. consumers. All eyes turning to next week's Fed rate decision as potential Fed Chair Kevin Hassett supports a 25 basis point rate cut and some inflation data coming up with today's PCE report from September and UMich sentiment data trying to fill in the gaps ahead of that key meeting next week. It should be a non-farm payrolls Friday. Instead, it is a University of Michigan in September PCE data kind of Friday.
But we do know that the Fed has reacted in the past to the University of Michigan, although we do know that it is incredibly partisan. Everyone usually comes out and says how they're feeling based off the economy, based off their political lines, although there could be some interest in that. Obviously, when it comes to PCE, this is the Fed's preferred inflation gauge, but it's from September. So does it even matter that we're getting this data today?
Right now, what I'm looking at is the fact that small caps are at a new record high, even though you are about 0.5% away from it when you look at the broader indices. When you take a look, since the end of April, the Russell 2000 has returned almost 30%. It is only 5 percentage points behind what the NASDAQ has performed as. So it raises this issue of how dependent is this index, the sort of small business indicator, to any Fed rate cuts versus something else, versus a real kind of momentum in the consumer in the United States?
Well, I think this chart speaks to two things. One is that you were able to get through Liberation Day and the low of this administration in terms of the market. And then, of course, the bond market really pushing back, being that barometer. And then everything was off to the races there because they realized that Trump is not going to be as aggressive when it comes to trade policy. At the same time, maybe there is a real broadening out, especially if you have a Kevin Hassett, potentially, as the president said, a potential next Fed chair, talking about, yes, 25 next week, and then that's what he would like to see continued as well into 2026.
How long do we have to do this for? I'm just curious. Like the Kevin Hassett sort of, is he or isn't he?
Well,
kind
it was
of
supposed to be the fall,
right?
And then it was supposed to be Christmas, and now it's sometime in the new year.
Sounds like a fun game. Right now we're seeing markets basically continuing to grind higher. It has been a slow grind, nonetheless, a consistent grind with the fourth potential consecutive day of increases. S&P futures up almost 0.2%. You are seeing bond yields continue to inflect just slightly higher, closer to that 4.11% level, and crude prices off by about 0.2% today. You got to wait until 10 a.m. to get that dated PCE data from September. That's when we get that core PCE as well as spending and income. Then at 10 a.m. also we get that University of Michigan sentiment survey. Coming up this hour, Chris Verone of Strategas as stocks look to round out the week with a fourth day of gains. John Lieber of Eurasia Group as Russia-Ukraine peace talks hit a snag. And Jill Carey Hall of Bank of America with small cap stocks, as we were just mentioning, at record highs. We begin this hour with stocks rising after closing near all-time highs. Chris Verone of Strategas, a Baird company who, by the way, was just ranked second among Wall Street's macroeconomists in an annual Extel survey. Writing this, as the calendar starts to run out on 2025, we continue to see more signs of positive inflection from the real economy and the market's daily message. Chris joins us now. Chris, first of all, congratulations.
Thank you.
Very exciting. And it comes at a time where there is more optimism. We're talking about the Russell 2000. Does this come with real sense that the overall economy is doing a lot better?
Well, I think there's clearly been a soft patch in 3Q, 4Q, but maybe more importantly, I think the market's looking through it. And you see it, as we write, in the daily message, the daily prices. When you look at, say, the transports breaking out here, the regional banks, the discretionary stocks have all inflected, copper making new highs. So I think there's a lot of almost reflationary pro-cyclical tones starting to weave their way through the market's message here. And, you look out to 2026, and I think it tells us that really the tone is changing from, after years of all the excess liquidity being soaked up by the speculative economy, I think the excess liquidity is now being soaked up by the real economy moving forward. Very important theme for us into 26.
Do you think that this is getting ahead of what we can see with respect to labor market gains? Do you think that this is actually coming in tandem with that hasn't necessarily been picked up by the data? In other words, is this already underway, or is this anticipated reacceleration on the heels of Fed rate cuts later this year, next week, as well as earlier next year?
I think it's a little bit of both. And kind of if you look at the trajectory of Fed policy into 26, I really don't think it matters who's the Fed chair. I mean, the two-year yield this entire time has been remarkably stable at about 350. That's probably where policy is going. I mean, think back just a couple weeks ago. Everyone was pulling their hair about, oh, is the Fed going to cut in December or not cut in December? I think the odds got down to like 25% at one point. You know what never moved? If you look at June 26 Fed funds futures, they were always about 330, 340. So I think the trajectory is pretty set. I suspect we'll get two more cuts here. But remember, most global central banks have been cutting for the last year. So I think a lot of this kind of market looking through some of the soft patch data is also in response to what we've seen globally over the last year.
Do you think this is going to be a hawkish cut, though?
Yeah, I don't really think it matters. It probably is. That's what the economists will say. I'm just not sure it matters. The two-year yield is telling us, I'm a believer, let's focus on the market rate, not the policy rate, right? The market rate's 350. That's probably where policy is getting. Whether it happens over 2 meetings or 3 meetings, I don't think the market cares too much. When you look at this pro-cyclical tone starting to rework its way through the tape, that's what I think is most important going forward.
You also spent a lot of time in Washington, D.C. I'd love to get your take on the Fed race.
Yeah.
I mean, at one point, does it even matter because we know the direction of travel? But do you really think it is going to be Kevin Hassett?
Well, I'll make a couple points. I would say, number one, I do think we're in this pretty important shift where the shadow of the Fed or the shadow of the Fed chair is probably getting shorter over financial markets than what we've been used to, certainly since the financial crisis, but maybe even going all the way back to Greenspan and Volcker, where really the Fed was the dominant player. I think that pendulum has shifted to Treasury here. It's almost a bit of a kind of a reminder of what the 1950s looked like in that regard, where Treasury shadow over financial markets and the bond markets was so large. So I think this pendulum has shifted. I think it frankly began with the Yellen Treasury going back to the last administration. So that has been underway here. You know, at the end of the day, whether it's Hassett, whether it's Warsh, whether it's Waller, I don't think the trajectory of Fed policy is dramatically different over the next 12 months here. And, you know, I would add one more point. You know, all this attention about it being Hassett, you know what didn't make new highs on this news is gold didn't, right? You know, it hasn't really moved as five-year forward. So I think the market's pretty comfortable no matter who ultimately it is.
I want to dig into this idea that the U.S. Treasury has a greater influence, especially in light of the story that came out that the U.S. Treasury market is now $30 trillion. It has doubled since 2018, and there's been a real question, how has the market absorbed all this issuance in an okay way? And the reason it really does lie with the Yellen Fed and now the Yellen Treasury and then the Bessent Treasury, a question of disproportionate issuance on the front end. Is that the reason why you think supply isn't going to disrupt long-term benchmark rates to the degree that some people were expecting?
Yeah, you know, actually, if you look at a long-term time series, we're still below kind of on the short end what the average issuance typically is. I think there's more room to expand issuance on the short end here. I would also just know, and we've written this all year, I mean, ironically, the U.S. bond market has been the envy of the world this year. When you look at what Japanese JGB yields have done, I mean, even German 30-year yields are back at the highs right now. I mean, U.S. 10s have been in the same range they've been in for the last 3 years. So I think until you get some resolution, either above 475 or below 375, you look at the shape of the U.S. Treasury curve and you say it's relatively stable. It has been. My suspicion is global curves do want to re-steepen here, though. We saw 3-month 10-year in the U.S. this week make about a 6-7 month high. U.S. 230s are starting to re-steepen. What is that good for? Real economy type stuff. Regional banks are following that.
Well, this is exactly where I wanted to go. Does this backdrop support the idea of the broadening out? And maybe the overall index isn't going to rise as much as some people think because you might not get the participation in the same kind of way as with big tech, but that broadening out trade is actually going to come to pass in a more material way in 2026.
Yeah, it's funny. I was heading over here this morning. I was reading the FT, and they had all the bank strategists where their S&P forecasts are for 2026, and they're all 7,500, 7,800. Targets are targets. We're in the business of direction and trend. I think the trend is up. It won't be a straight line as we know, but I think maybe more importantly, it does look like the complexion of the leadership is evolving here. I mean, for the first time in 3 years, Energy is involved for the first time in a number of years. Healthcare is involved. Consumer discretionary. We talk about the UMIS survey today. Ironically, you want to be buying consumer discretionary stocks when consumer sentiment is as poor as it is right now. You've seen the transport start to wake up here as well. So all of this has this real economy vibe that frankly has been elusive for markets for much of the last several years.
We did basically an entire conversation of 10 minutes without mentioning AI. Do you still think we're going to see new highs when it comes to artificial intelligence, NVIDIA next year?
These stocks are still in uptrends. NVIDIA still is in an uptrend despite it correcting here. Broadcom still in an uptrend. Taiwan Semi still in an uptrend. But I think they're becoming less of the main show here. What I want to watch, and this is really kind of going back into our work from 99, 2000 and remembering, what started to shift. It was all the internet posers or the derivatives or the adjacent internet stocks that peaked first before they got to the main show, which was the Ciscos and all the like. So I think when you kind of compare that to today, watch all the, quote, AI derivatives today. My suspicion is they would peak first before NVIDIA peaked or before Broadcom peaked. So that's kind of how we're thinking about, what's the appropriate analog or approach here.
Yeah, data centers, for example, at what point do they peak out?
Well, they trade terrible, actually. I mean, if you look at DLR or Equinix, those are the two publicly traded big data centers. They're in bear markets. So that's probably the one place where I think the market's already pushed back against the idea.
Chris Ferrone, wonderful to see you.
Great
Thank you so much for being with us. Chris Ferrone of Strategas talking about how much we are seeing the real economy come back. And AMH should just think about copper and how it's reached one record high after another. People pointing to the need for supply, the stockpiling by a lot of countries ahead of this AI build out.
And also the fact that they're trying to get a lot of copper into the United States because there is a little bit of uncertainty in this market. And that's the president did say he's going to revisit whether or not he's going to put the duties up, the tariffs up when it comes to copper. And if you're in this trade, you want to get ahead of that.
Yeah, Citi analysts forecasting a 2.5% rise in global end-use consumption by the end of next year. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vani. Vani.
Lisa, thank you so much and good morning to both of you. The US urging several countries in the European Union to block the EU's plan to use frozen Russian central bank assets to back a massive loan to Ukraine. According to European diplomats familiar with the matter, officials are arguing to member states that the assets are needed to help secure a peace deal between Kyiv and Moscow and shouldn't be used to prolong the war. National Economic Council Director Kevin Hassett said the Federal Reserve should cut interest rates at its meeting next week. Hassett expects the central bank to cut by 25 basis points, but said he wants to, quote, get to a much lower rate over the long run. His comments coming as speculation grows that President Donald Trump is preparing to nominate him to lead the central bank. Warner Brothers Discovery entering exclusive negotiations now to sell its film and TV studios and HBO Max streaming service to Netflix. Sources telling us here at Bloomberg, the streaming giant is offering a $5 billion breakup fee if regulators don't approve the deal. The two companies could announce a deal in as soon as the coming days. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vani Quinn. Up next, Europe on the hook for Ukraine.
This is a European issue. This is something that Europe is trying to deal with. We want to make America great again, but we'd like Europe to be right there with us.
John Lieber of Eurasia Group joins us next with futures higher on the morning, potentially the fourth straight day of gains. This is Bloomberg. It looks like the Santa Claus rally is underway. What you are seeing is potentially the setup for a fourth straight day of gains with stocks nearing new record highs. You already have a record high on the S&P, on the Russell 2000, the S&P. Less than 0.5% away from that, now up 0.2%. NASDAQ futures up 0.4%. Big question mark is in the bond space. Michael Hartnett over at Bank of America said that the only thing that can stop a Santa Claus rally is a dovish Fed cut causing a sell-off in the long end. Right now, you are seeing that slight yield curve steepening with 30-year yields up just about a basis point, 4.76%. 10-year yields up about a basis point as well. A real question here, Annmarie, about the credibility of a dovish pivot for a Federal Reserve at a time where the economic data isn't that bad.
That could basically spook the market. Maybe they then would expect that, oh no, if the Fed is really, really nervous, then the economic slowdown might be worse than some of the data we are seeing suggest. We're going to get a lot of a clearer picture, not next week, but when we get the non-farm payrolls report the following week. And then at that point, we could see, was the Fed prudent in their decision, depending on what they say in their commentary, or not?
Also, a big question is the inflation and the cost of living inputs. If you take a look at natural gas over in Europe, it has been actually falling. In the United States, not so much. Natural gas prices have been increasing. A real question and focus on geopolitics. Under surveillance this morning, Europe on the hook for Ukraine.
This is a European issue. This is something that Europe is trying to deal with. If you want to know where the United States stands on it, you'll have to talk to Ambassador Witkoff or Secretary Rubio or Jared Kushner, who are very involved in these negotiations. We want to make America great again, but we'd like Europe to be right there with us.
Here's the latest. European sources saying the U.S. urges several EU members to block plans that would use frozen Russian assets to back loans to Ukraine. Bloomberg's Rich Bravo joins us now from Brussels. Rich, great to see you. I'm just curious, from your perspective, what you think the motivation is in saying, hold off, don't use these loans just yet to back up Ukraine, even as Europe really bears the onus for financing the ongoing war.
Yeah, that's exactly right. I mean, the burden really is on the Europeans now, since the U.S. has pulled back its support, its financial support for Ukraine. So it really is up to the Europeans to make those financial pledges to Ukraine. And the reason why the U.S. is, our reporting says that the reason why the U.S. is pushing the Europeans not to use these assets is Washington would prefer to use these assets as a means of leverage to try and broker a peace deal between Moscow and Kyiv. So it really is a tough situation for the Europeans. They know that Ukraine's funding will run out at some point in the beginning of next year, and they're struggling to really get this massive loan proposal across the line on a domestic front. Then to have the U.S. lobbying against it really puts Brussels in a tough position.
Just quickly here, Rich, what do Europeans suggest in terms of how to bring an end to the conflict, not just finance the ongoing defense against Russia?
Well, I mean, one thing they want to make sure is just bolster Ukraine as much as they can, make sure they have money, make sure they have weapons, and they're able to continue fighting this war in a way and keep the front line where it is, so that when a ceasefire does happen, if a ceasefire does happen, the battle lines are somewhere advantageous, so that they do have more leverage to negotiate an end to the war.
Rich Bravo, thank you so much for being with us this morning. Really appreciate it. Joining us now is John Lieber of Eurasia Group. John, I would love your sense of what the United States is doing in their approach to suggesting that the European Union members do not extend these loans to Ukraine. What do you think the end game here is?
I mean, the end game in the Russia-Ukraine war, it probably is going to be decided either on the battlefield or with the Russian economy, because those are the two variables that are most likely to drive an outcome. But with the immediate question of financing the ongoing war, this is a real challenge. It wasn't clear that the Europeans were going to be able to coalesce around a plan to use these frozen Russian assets in the first place. We believe they probably will, and they'll probably do it this month. If they don't, or if they can't, and these objections from the U.S. and Belgium are, of course, real and present serious obstacles. But if they can't, then we also think that more common borrowing is likely to happen in order to support Ukraine. The Europeans are very committed to their defense, and we don't see a scenario right now where they don't find a way to deliver more money to Ukraine, either from Russia or from their own ability, their own purse.
John, we also have the U.S. National Security Strategy released this morning from the President of the United States, and he talks about Europe, and he says the larger issues facing Europe include activities of the EU and other transnational bodies that undermine political liberty and sovereignty, migration policies that are transforming the continent and creating strife. It's really critical of the European Union. How far apart is this administration right now between Brussels?
Yeah, I don't think the Europeans have a lot of fans inside the Trump administration. This is not an administration that prioritizes multilateralism. It's not, President Trump sees the European Union combined as a way to threaten the United States, and in a way, he's got a point. I mean, the whole point of the trading bloc is to be stronger together than any individual country is separately, and of course, that represents a threat to the world's largest, most powerful country. This is, and I think that it's interesting that they mentioned migration in the national security strategy. This was, of course, one of the focuses of J.D. Vance's speech that he gave at the Munich Security Conference this last year, that individual countries were being robbed of their sovereignty and forced to accept this immigration policy they didn't agree with. And that was fundamentally upending these societies, which, of course, is core to the sort of MAGA argument about the United States. So this is, we're in a new world now, and these alliances, this multilateral approach that the U.S. used to lead, is simply not something that the Trump administration cares about. I think the Europeans should be very concerned about this approach and this new tone from the administration. And I don't see anything that's going to help it get better.
Do you think, though, we can get a deal on Ukraine without the Europeans at the table?
Yes, I do think you can get a deal on Ukraine without the Europeans at the table, but it's not going to be one that's good for Ukraine or Europe. Because, I mean, one of the big threats throughout 2025 is that the U.S. and Russia just decide to get together and force a peace plan on the Ukrainians that's unacceptable to both them and Europe. Those odds have faded, and I don't think that's likely to happen right now. But you see Trump's increasing interest in getting this deal with Russia, and you see him more desperate to get a peace deal, and that's going to continue into 2026. And that's bad news for the Ukrainians, who look like they are on their back feet right now on the battlefield and are going to have serious attrition problems and serious problems fighting this war going into next year. So they are looks like they are in an increasingly weaker position as the U.S. is more interested in aligning with Russia to end the war, and that's bad news for the Europeans, obviously.
John, just taking a step back, it seems like the U.S. is getting increasingly involved in a number of geopolitical issues, whether it's the Ukraine-Russian negotiations or whether it's with Venezuela. At the same time, increasing questions mounting around Pete Hegseth and his leadership of the Defense Department. I'm just wondering, for your perspective, how much that complicates some of the United States' geopolitical involvements, given the sort of ongoing question of his fate and the support of the president.
I mean, Hegseth isn't exactly, I think Hegseth's a bit of a figurehead role at the Department of War, as they're calling it. I think if you look at foreign policy, a lot of this is being driven clearly out of the White House. Marco Rubio is an incredibly influential advisor, being both the national security advisor and the Secretary of State. And Trump's also surrounded himself with a number of people that he's known a long time, who he trusts quite deeply. And we heard this in the clip prior to this, people like Jared Kushner and Steve Witkoff. So Hegseth's credibility and his role at the Department of Defense, I think, matters for deploying military assets, which of course the U.S. has no problem in doing. But I don't think he's one of the key drivers and shapers of U.S. foreign policy right now. That is coming from Trump, his immediate advisors, and of course, Marco Rubio.
John Lieber of Eurasia Group, thank you so much for being with us. As we look to what the U.S. is requesting from Europe wanted to seize these loans, use them, Russian assets, use them for financing to Ukraine to continue gaining leverage ahead of these negotiations. A real question of any kind of critical mass, an agreement, and issuing common debt to support those efforts if this doesn't come through.
Potentially they're going to have to, but how challenging is that going to be for Europe right now? Also, this needs to get through Belgium, where these funds are. And I think you have serious concerns within Belgium that potentially these funds can go out to Ukraine. But then if a deal is struck and Russia comes back and says, we want those funds, who is going to be left on the hook to pay for them?
Yeah, and what does this do in terms of the demand for gold? Remember back when the United States kicked off this discussion around potentially seizing Russian assets, that's when you first started to see gold pick up and a shift away from the dollar. The dollar has been actually on a weakening trend, although real questions emerge as you do see strength in the U.S. economy. Coming up, Jill Carey Hall of Bank of America with small caps, an arbiter of just how much strength there is at a record high. Plus, Yahira Anand with your morning movers. Ulta rising with consumers continuing to spend on cosmetics. Good morning. This is Bloomberg Surveillance. We are are potentially seeing another record high, just inching back toward that on the S&P 500. Equities more broadly doing really well, led by the small caps. Not today. You're seeing small caps up just barely, just a touch above flat. NASDAQ futures up 0.4%, regaining the lead with S&P up 0.2%. The NASDAQ hit a record high a while back. It is up 35% since the end of April. The Russell 2000 has returned almost 30% in that same period. Why? Potentially because there could be more Fed easing that could potentially pave the way to greater reacceleration. If you look at 2s, 10s, and 30s yields, just climbing a touch on the long end in response to any kind of potential Fed rate cuts that might come without the commensurate weakness. I keep going back to this, Annmarie. Michael Hartnett over at Bank of America talking about what could potentially kill this Santa Claus rally, saying it would have to be a dovish cut, indicating further rate cuts coming in the year ahead. This would lead to a rise in the long end of the yield curve. Yes, you also potentially could get pessimism in the overall economy, but it also speaks to an overall dovish tilt at a time where the economic data is not screaming pain.
The economic data is not screaming pain, and the consumer is resilient, as Mohamed Al-Larian said. If you look through, even if you do see individuals being choiceful, maybe trading down, the consumer is still going out and spending. I think it's going to be interesting the first 3 months of next year. Is the consumer spending today because they know they're going to get those tax refunds, and it's going to be an incredibly challenging environment next year? And what the political polls are showing is that consumers are saying it has been hard to keep up in this affordability. What Michael Hartnett is saying is interesting, because usually you think dovishness, good, we're off to the races. What he's saying, this might actually say to investors, actually, the Fed might be more worried than you are.
Yeah, and it's the Dollar General and Walmart gains a good thing or a signal of pain elsewhere. 3 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We start with Ulta. Those shares are rising in the pre-market after the company raised its full-year outlook on strong results, highlighting consumers' reluctance to give up their beauty routines despite cutting back elsewhere. And the CEO says they're off to a strong start this holiday season because apparently, she says, more people are planning to gift beauty products during the holidays. Meanwhile, HPE not having the same luck. Those shares are down 9.5% in the pre-market after the company delivered a softer than expected sales outlook, a blow to hopes that high server demand, AI server demand, would drive a bigger jump in revenue. And part of that weakness was due to order delays, with the CEO saying that big government and European deals slipped into 2026. And that was an issue with a data center delay not being up and ready yet, and the government shutdown. And we end on SoFi, those shares falling 7.3% in the pre-market after the company announced the share sale of $1.5 billion, which of course is a diluting event. But it follows a massive rally with the market cap nearly doubling this year. So it is striking while the iron's hot, with plans to use that fresh capital to fund future growth. And BI says that it wouldn't be surprising to see SoFi pursue M&A given this move. Lisa?
Thank you so much, Yahaira. On our radar this morning, the U.S. urging EU members to block a massive loan to Ukraine backed by frozen Russian assets. U.S. officials arguing the assets must be saved to secure a peace deal, not to prolong the war. Elsewhere, more threads. A leading Chinese AI chipmaker founded by a former NVIDIA executive jumping over 425% in its Shanghai trading debut. The move fueling optimism for China's goal of achieving tech self-sufficiency amidst trade tensions, and raises a question about national champions around the world and how much investors are trying to chase the backing that comes from corporations.
And if you think that NVIDIA is not going to play the long game or be able to because of national security concerns in the United States, in China, who is going to fill that void? And what better than someone who actually used to work at NVIDIA at the helm of this company? But I think this shows that this really is, as Jensen Huang will tell you, China neck and neck with the United States when it comes to AI. And I wonder if this story actually plays into all the lobbying efforts he is doing in Washington, trying to tell policymakers, at least in his view, we should get China and the rest of the world addicted to our tech so that we are not competing with them at this level.
Yeah, and this is one reason why you are hearing that drumbeat, an increasing shift in the view of what national security looks like. It also, though, highlights how much countries are choosing national champions. And they're saying whether it's Intel or whether it's this one, these are the ones that we want to win. Whether they will win is another story. And I think we are writing the book in real time on just how much this will be successful. Yes, the initial pop, yes, but in a historical context, is these haven't always been the biggest winners in the end.
True, haven't always been the biggest winners, but you could see that at least in China, they do pick winners and losers and will put a lot of effort behind that. We are seeing some of that state capitalism also in the United States, but it is because semiconductors are just not important for your iPhones and consumer products. These are important companies and industries for things like the military, which is why you see really this outproportional emphasis from governments on these types of companies.
Yes, indeed. And we'll keep tracking this. Warner Brothers Discovery, meanwhile, entering exclusive talks to sell its film and TV studios, along with HBO Max, to Netflix. Sources are telling us here at Bloomberg a $5 billion breakup fee is on the table if regulators block the deal, which could be announced in the coming days. Both those shares trading lower in pre-market activity. Just getting a headline that is crossing currently, and it kind of builds on what we've seen from other airline companies, Delta in particular, saying that the hit that they're going to experience from the government shutdown is significant. Southwest coming out and cutting their full year forecast, saying that they see the full year EBITDA about $500 million versus the expectation previously of $600 million to $800 million. A real question here, how much this is a shutdown capacity? How much is this demand from people who are less well heeled? We'll bring you any information as we get it. Those shares lower by 2.3% in pre-market trading. One of the small caps we're keeping an eye on, given the fact that this has been the outperforming sector. Turning to those small caps, the Russell 2000 closing at a fresh record high ahead of the Fed's widely expected rate cut next week. Jill Carey Hall of Bank of America writing, we see support for small caps from improving earnings, guidance trends, and Fed cuts. Jill joins us now. Jill, thank you so much for being with us. I want to start with a real question. How much are small caps doing better because of an expectation of Fed rate cuts? And how much are they doing better because their actual businesses are doing really well?
I think both are a big part of it. I mean, really, over the last 2 years, you've seen this increased sensitivity of the Russell 2000 to Fed expectations and the factors driving that. And so that's been one big driver and one reason we got more constructive in August, because Fed cuts were projected to restart. But I think, one reason we had been cautious on small caps for a lot of earlier this year was the fundamental story. And, investors were expecting this big profits recovery. Small caps usually recover out of a profits recession faster and harder than large caps do. But we hadn't seen that, and the can kept getting kicked down the road. So finally, this summer we were seeing evidence that small caps were out of the profits recession, revisions were trending up, guidance was positive. Usually corporates can be more conservative, but they're actually guiding above consensus more than below.
How much, Jill, is this coming because of higher volumes and actually more consumer activity? And how much is coming from better balance sheets, more efficiencies, better use of technology, and all around a greater degree of productivity?
Well, I think when you look at this year, it's been kind of interesting. I mean, performance year to date has been this barbell of mega caps outperforming and then micro caps outperforming. And that's made it a really tough environment for small cap active fund managers because they tend to tilt up in quality and up the cap spectrum within their small cap universe. So very few small cap managers are ahead of the benchmark year to date. And, one of the dynamics that we've seen this year was elevated retail trading. That's a dynamic we've seen post-COVID, but much higher volume in terms of what's been driven by retail, particularly in small caps. So I think, that's driven up the concentration within the Russell 2000. If you didn't own those particular stocks, that made it more challenging. The Russell will move to a twice-a-year rebalancing next year rather than once a year. So if a stock gets really big and out of the small cap range, it's stuck around longer. That will help to mitigate that. But that's been another factor. So I think the retail trading, the dynamics that we saw with micro caps outperforming, lower quality stocks outperforming, those were happening even at parts of the year when small caps themselves were lagging large caps.
Joe, how much of this is, we're more than 10 months into the Trump administration. There was a ton of policy uncertainty at the very start. How much of this is also driven by there has been some more clarity, especially when it comes to where the administration is going when it comes to trade policy?
Right. And I think that's, another reason that helps to be more constructive on small caps next year is, we saw small caps get hit hard given the uncertainty around tariffs. They do have the thinnest margins of the size segments. So, higher input cost is a bigger hit for these companies. And so if we are in an environment where effective tariff rates are, potentially lower, if there are some exemptions, some potentially easing of tariffs, and just greater certainty, that's a help to small caps. Small caps tend to do well when there's less volatility and uncertainty. If we see deregulation, that should be a benefit. So certainly a number of factors that created greater uncertainty for small caps early in 2025, but we could see more positivity in 2026. M&A activity has also picked up. And while it doesn't tend to necessarily be a driver for the small cap index overall, it has tended recently to be a factor that's caused targets to outperform more than usual. It's an environment where certain sectors within small caps, healthcare, for instance, has been one of the best performers year to date within small caps, and M&A and the sentiment around that has helped.
Well, I wanted to ask you about that, this deregulatory push from this administration. Are you expecting that pickup in M&A to continue throughout next year?
Yeah, I think we and our analysts in a number of sectors definitely see the case for continued M&A activity. We've seen the pickup this year. It started even before this year. Healthcare has been a big driver. We've seen more banks M&A activity this year. So there's been several sectors where we've seen a pickup. And we still haven't necessarily seen a lot of bigger deals, mega cap or even really mid cap deals. But we have started to see deals get done quicker. And, in sectors like healthcare, where there was a lack of M&A for quite some time, this has helped sentiment. So, macro conditions need to remain supportive. M&A is cyclical, but the fact that small caps are still relatively cheap versus large caps and the macro environment has remained supportive has certainly been a positive factor.
So just from an economic perspective, how difficult is it to get a full read on things, given the fact that we're not getting non-farm payrolls, we're not getting a whole slew of other economic data, and we have mixed reports from different corporations? On one hand, Walmart and Dollar General, yay. On the other hand, not so much, because these tend to outperform in times of economic distress.
Right. Yeah, I think, we've been in an environment where there's been a lack of data. And, at Bank of America, we have a number of reads from the B of A Institute and on our internal data. But I think, overall, we do expect the Fed to cut next week. And, we expect 2 more cuts next year. So that is still an environment that should be supportive for small caps, given the refinancing risk that these companies face. They're more levered than large caps. They have more short-term and floating rate debt, more debt coming due over the next several years. But, I think some of the macro factors that are going to be most important for small caps beyond just the overall condition of the economy and the consumer is the manufacturing backdrop. We've struggled to see the ISM climb back into expansionary territory, and that's an indicator that's, highly correlated with small caps. And then the credit backdrop, where obviously we saw some signs of concern over the last several months. We're watching that. So far, not necessarily signs of broad-based credit deterioration, but small caps are highly sensitive to the credit backdrops. So those would be 2 key factors we're watching as well.
Jill Carey-Hall of Bank of America, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. The European Commission is fining Elon Musk's X nearly $140 million for violating the EU's content moderation law. It claims the social network misled users with its paid-for blue tick symbol and stonewalled researchers' access to data. It marks the first fine under the EU Digital Services Act. X has 90 days to implement the changes, or it could face additional penalties. The U.S. Senate is seeking to ban NVIDIA from shipping advanced AI chips to China. They've now introduced bipartisan legislation to prevent the Trump administration from easing export controls. It comes amid reports that the Trump administration is considering relaxing restrictions on exports to China. The bill urges maintaining rather than loosening those export controls. Democratic Senators Elizabeth Warren and Jack Reed are reportedly demanding tighter credit rulings for banks engaged in private credit. According to the Wall Street Journal, the lawmakers are citing the BlackRock debt write-off as proof investors can suffer in opaque markets. The senators are pressing regulators for immediate action and a mandatory private credit stress test. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. I know that everyone is shocked about that potential proclamation for more regulation.
Oh, right. Elizabeth Warren, Senator from Massachusetts, asking for more regulation in the banking sector. I don't think anyone's surprised about this morning. The day ends in Y. There's going to be a letter.
Which is the reason why I think a lot of people are looking past that to what's going on the monetary and fiscal side. Up next, pushing for lower rates.
We've got to get to a much lower rate. If there's consensus around 25 basis points, which it looks like there is, then I'll take it.
Kelsey Barrow of JP Morgan Asset Management joining us next. Good morning. This is Bloomberg Surveillance. Trying to end with a new record high, the Santa Claus rally gaining steam. The S&P 500 up throughout the morning after three straight sessions of gains. The Russell 2000 has been leading the charge, less so today, up 0.2% on S&P futures. You also are seeing a lift to bond yields, a question of what the influence of the Fed will be over the longer end. 10-year yields now almost at 4.11. And check out shares in pre-market trading of Southwest. Southwest cutting its operating profit for the full year to $500 million. Previously, they had said $600 to $700 million. The expectation here that some of their profitability crimped by the government shutdown. They are seeing bookings return to normal. Those shares lower by 2.2% in pre-market trade. I'm just curious if this is a broader trend, too, whether this really does speak to any kind of consumer pushback or if it is government shutdown related.
Well, the government shutdown was the longest in history, more than 40 days. And at the same time, you cannot make up that demand. That's it. It is over. So they're citing this as being potentially this one-off hit. On top of that, also higher fuel prices. Maybe jet fuel has been higher for some of these airlines. They say that bookings are back to normal, so potentially for the airlines, smooth sailing for 2026. But you can't make up the fact that people were just stuck, not traveling, because a number of individuals were not getting paid.
You heard the same kind of thing from Delta. This just adds to the sort of muddied waters behind the backdrop of the Federal Reserve under surveillance this morning, pushing for lower rates.
We've got to get to a much lower rate. If there's consensus around 25 basis points, which it looks like there is, then I'll take it.
And if you were Fed chair, would you want to keep doing that how many times in the beginning of the year?
You know, as Fed chair, what your job is to look at the data, see how it's going, and make sure that you're, keeping unemployment low and inflation low. And depending on how the data move, that you move interest rates in response to it.
Here's the latest. NEC Director Kevin Hassett reiterating his call for lower rates as Wall Street voices concern over his potential nomination as the next Fed chair. Kelsey Barrow of JP Morgan Asset Management writing, the market has been incorrectly pricing rate cuts in December and January as interchangeable rather than cumulative. Kelsey joins us now. Kelsey, you're right. We've actually seen a decline in the probability of a January Fed rate cut as people have increased the probability of one next week. Why do you think this is wrong?
Yeah, so what we've been seeing is the pricing for a December rate cut and a January rate cut over the last month have been negatively correlated. So when December came down before the last payrolls report, you saw January go up. So people were generally thinking these are interchangeable. Now, the reason that I am skeptical about that, there's a few. One is the continued deterioration in the labor market data, which to us signals that the Fed is likely to deliver not just the December rate cut, but also one in January. But more importantly, just from a market probability perspective, I think that ahead of the jobs report on December 16th, which coincidentally comes after the Fed's decision, that you should be pricing in a probability for January that's really closer to 50-50. So if we're coming out of the December FOMC meeting and we get this hawkish cut that most of the consensus at least expects, and January probabilities are still as low as they are today, below 30%, I think that's actually a decent risk reward heading into the October-November combined payrolls print, where I think you're probably more likely than not going to see more softness in the data.
So why do you say that? Yesterday we got initial jobless claims. We haven't mentioned it once this morning. People seem to have just rejected it. It came in at the lowest level that we've seen going back to 2022. I believe only once before in history it's been this low since the middle of the last century. So how do you square that with ongoing weakness that you think will justify further rate cuts?
I don't deny that it is a peculiar situation, and the data is not clear completely. And I don't know if it will ever be clear completely. But here's what I would say. In terms of initial jobless claims, we broke below 200,000. It was during the Thanksgiving week. There are sometimes quirks around that. But at the same time, we did get the challenger job cuts. And if you look at the cumulative amount of job cut announcements this year, relative to prior years, we've actually seen the most layoff announcements in that challenger survey since 2009. So it's unusual actually over time to see that big of a disconnect between initial jobless claims and the challenger layoff series. Now, there could be reasons for it. It's announcements, right? Challenger is announcements, not things that actually happen. So there could be some of a timing mismatch. But I think more broadly, when you look at the mosaic of data, it's still telling you that the risk of a reacceleration in the labor market, a risk of a wage price spiral, which is the most important thing for the Fed in terms of being able to maintain an easing bias, those are all still fairly low.
When it comes to the December 16th non-farm payrolls report, what is the bar of how low it needs to be for the Fed to cut in January in your mind?
Well, I look at things like the ADP and Revelio data, which we have through October and November already, and they're flagging the risk of something closer to zero. So if I think about it, we have the September NFP, job growth on average for the last 6 months in that survey is around 60,000. Then you compare that to where the 3 and 6 month moving averages for job growth are through November for Revelio and ADP, and those are closer to zero. You know, you look at the last 6 ADP prints, 4 out of the 6 of them have been negative. So I'm not necessarily calling for a negative print. I am calling for something that is softer, something that biases the unemployment rate slightly higher. We were nearly there in the last report at 4.44 on the unemployment rate. That could round up. And again, this is still, at least from the market's perspective, a low hire, low fire, sub-trend growth environment, not a recessionary environment, but one where the labor market is squishy enough that the Fed has ample justification to maintain the easing bias and gradually cut a few more times.
I just have about 30 seconds left. Michael Hartnett saying that if the Fed is overly dovish, that will lead to a rise in long end yields. It sounds like you disagree. Is that correct?
It depends, obviously, on the mix of data. I think the market would be surprised by an overly dovish message ahead of key data points. And so there is a bit of a sequencing thing here. I think the way that the Fed should approach it is to have more of a neutral bias. I think that makes sense given that that just 6 days later or 5 days later, you're going to have a lot more information than you did before.
Kelsey Barrow, thank you so much for being with us. Kelsey Barrow of JP Morgan Asset Management, and AMH is shaking her head.
It doesn't need to be this way.
I know.
Just move the meeting.
She's going to keep her lobbying. Just move the meeting.
It's circumstances that you couldn't predict. Have all the data going into the next Fed meeting.
Yeah, and the second we get the data, people are going to say, how clean is it? And can we actually read that much into it? So we will have these debates on an ongoing level. Coming up next, we will continue that. Kate Moore of Citi Wealth will be joining us, plus David Steinberg of Zeta Global, Abby Yoder of JP Morgan Private Bank, as we look ahead to a really big week. The Fed has to decide amid a dearth of economic data. We should be getting non-farm payrolls. Instead, we're getting University of Michigan sentiment. This is Bloomberg Surveillance.
Everybody's talking about this K-shaped economy, and I think it's real.
It's been the tale of two consumers.
This is a structural problem.
The recovery isn't really in sight.
There are a number of upside risks as we look out to the end of the year
and turn the calendar page into 2026.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks inching back to record highs with optimism fueled by ongoing resilience among U.S. consumers. All eyes now turning to next week's Fed rate decision. Potential Fed Chair Kevin Hassett says he does support a 25 basis point rate cut. Some dated inflation data coming up later today. We are getting a mixed read on the U.S. consumer. On one hand, we've got the likes of Walmart and Dollar General that are doing really well, Annmarie. On the other hand, you've got Southwest coming out and actually downgrading their earnings forecast for the year.
So Southwest, though, could potentially be linked to what happened with the U.S. government shutdown. Longest in history. They're saying that part of this is because of that. Maybe they're leaning heavily on that, but you can't make up that lost demand. That's it. People didn't fly. A lot of Southwest individuals linked to potentially federal workers flying around the country, also individuals that have jobs because of the federal government. They're contractors too. So potentially that's part of it. And then when it comes to Dollar General, Dollar Tree, Walmart, is it a sign that the economy is actually not doing well because maybe those higher income spenders are actually looking for deals on the lower end?
Right now, what we're seeing is people pricing in their optimism, in particular with the Russell 2000, hitting another all-time high yesterday. Notable to see the gain so far since the end of April in the Russell 2000, up 30%. So the real issue is this because the Fed is expected to cut rates? Is this because of actual strength? Or is this because a lot of these companies are getting better at becoming efficient, cutting jobs, using technology, and actually doesn't speak to an overall economic boom?
Well, this year they've had to learn to do that. They were given a tremendous amount of uncertainty with the global trading landscape as well with the Trump administration. What they've been able to do is really weather that storm in terms of passing on some of those costs, but not all of them, and being able to be as efficient as possible.
We are getting some breaking news currently. Netflix is going to buy Warner Brothers. This is just crossing. This had been something that we were talking about throughout the morning. Netflix is planning to buy Warner Brothers for an enterprise value of $82.7 billion. The cash and stock transaction valued at $27.75 per Warner Brothers shares. You are seeing shares slightly lower in pre-market trading of Netflix, down about fluctuating here, but down about 0.5% one way or another. This comes after a lot of rumored speculation, including a breakup fee that Netflix would pay to Warner Brothers of $5 billion. But it comes after so much drama around these names.
So much drama, because remember, this was a bidding war. Netflix was really the dark horse. Everyone thought it was going to be Paramount, especially given David Ellison's link to the Trump administration. He was in Washington, D.C. this week trying to lobby them. There is concern about the regulatory approval when it comes to Netflix and the antitrust concerns. And you have a number of congressmen in California also speaking about this. You have a letter to Variety from some film directors that they say, prominent film directors are part of this letter, talking about the potential antitrust issues. So that $5 billion breakup fee seems to be what put this over the edge. I am surprised, though, how quickly. Just last night, we broke that they entered these exclusive negotiations, and today they got the deal done.
We'll be developing the story as we learn more throughout the morning. Right now, futures higher as we look to potentially clinch a fourth straight day of gains on the S&P 500. Meanwhile, you are seeing the outperformance from NASDAQ, 0.2% gain on the S&P, yields marginally higher to 411. And you are seeing just that range-bound dollar weakening trend that has kind of hit a stall speed in the past couple of sessions. Coming up this hour, Kate Moore of Citi Wealth. As investors eye that fourth straight day of gains, David Steinberg of Zeta Global with a new view of the consumer this holiday season, and Abby Yoder of JP Morgan Private Bank on whether big AI bets are cashing in. We begin this hour with stocks inching higher ahead of a long-delayed inflation information report. Kate Moore of Citi Wealth writing, we remain fully invested in equities on this nominal growth backdrop and prefer gold over long end duration as a hedge to risk given the upward pressure on rates. Kate, I am so pleased to say, joins us now for more. Kate, good morning. Thank you for being with us.
Good morning.
So this has been a market that you've been cautious about for a lot of this year. You still see reasons that maybe the everything rally can't continue forever, but the tone has shifted. Why?
Okay, so it's not that I've been cautious. It's that we didn't aggressively add to risk because we prefer to take our exposure in large caps. And I continue to, even after seeing some of the small cap rally. I think most of that, and you kind of led into this a moment ago, has been around rate cut expectations. And relative to some others, we don't think the Fed should be cutting rates at every meeting from now until next June. I know some people are hoping for that and some pricing that in. And we think small companies desperately need that in order to really sustain a rally and to have better earnings and fundamentals. So we prefer to take our risk in the large caps space. We've done quite well there, but it's not that we've been out of the equity market or been underweight in any way, shape, or form. We just want to be where the earnings are and where the free cash is and where we have visibility. And that served us really well this year.
So what you're saying is it sounds like you don't buy that there is this truly durable rotation into small caps and to expand out of just where the leadership has been. Is that correct?
Yeah, I want to. And I know so many people have written their year ahead report saying, once again, same thing they did at this time last year. Next year is going to be a year of broadening. It's going to be a year of broadening in sectors. It's going to be a year of broadening in terms of regions. And I'm not a buyer of that today, this first week in December. And let me explain why. Because we are kind of later in the cycle. We are at a point where you can pick and choose whatever economic data you want to fit the narrative you want to tell about the overall macro and what policy might do to respond to that macro. And I think you have to be very anchored to fundamentals. And where we have visibility into fundamentals, where we can see earnings, where we know that companies have the ability to weather any kind of storm in the economy, whether that's a bit of inflation spike or a slightly weaker labor market or policy headwind, that's where we want to be anchored. And I think many investors will as well. You don't just rotate for the sake of rotation. You just don't buy the laggards for the sake of it. In fact, we have done a bunch of quantitative studies to show that when you employ that strategy, particularly after a full year of performance of kind of tech and comms, et cetera, you don't perform as well. Some of these things that are doing well deserve it, and we don't rotate for the sake of rotating.
But isn't the table set this time around better than it was last year in the sense that the Fed looks likely to remain accommodative?
Yeah.
You have a deregulation push from this administration, and the trade policy uncertainty is now behind us.
Well, so let me say this. We are really constructive on the deregulatory side, and it's a reason we've been talking about the opportunity in banks. I realize I do work at a bank, but I also can be objective, and my job is to make my clients money in all parts of the cycle and in all sectors. So, yeah, I see the deregulatory side as a good tailwind for parts of the market and for the economy. On the trade side, much of the uncertainty is behind us, but not all. And I like to say we were past peak tariff shock, but we're still kind of working through what's going to happen with the IEEPA tariffs, which tariffs are going to be enduring, what will trade look like. Look, I'll be honest, I'm encouraged when the administration is pulling back or rolling back some of the tariffs they employed. I think that's I'd like to see a more moderate inflation environment, but we know that higher prices are still filtering into the costs and to the end prices that companies are charging consumers. So I don't think we're past the concern. I think people are tired of talking about it and want it to go away. But inflation, I think, is spicier than many are pricing in the market. That's a core view of mine.
Lisa and I have been talking about all week what the signal should be from the dollar stores and Walmart. Is it a good signal in the economy and the consumer, or is it actually a negative one?
I think it is a cautious signal. I think we are getting consumers who are continuing to spend. We like this, but they're continuing to spend in a way that is conscious of, brand. It's conscious of value, and it's conscious of where the best deals are. We all know how this went kind of over Black Friday and the following weekend. Consumers are, if they're in the big box stores, they're using their phones to price check at the same time. And we saw more people shopping online than in the stores than we have historically, continued to see that trend. And that's largely because people are comparison pricing on prices. And I think that's a smart thing to do. But they are not stopping spending. But we do need to be recognize that we are at this later part of the cycle, that consumers are a bit fatigued. This has been a tough year. They don't feel many things are affordable, from the regular basket of goods to housing, et cetera. And we need to listen to that, and the administration needs to listen to that as well.
So you talk about how you are somewhat looking at the large caps to continue to outperform. You're not screamingly optimistic about the U.S. economy. At the same time, not seeing long duration as a hedge. I wonder how much this has to do with the glut of supply, not only coming from the Treasury market, but also from the corporate bond space, as it helps to finance a lot of the AI tech boom that we're seeing.
Yeah, so we've seen an uptick in some of the financing, obviously, for AI projects and AI adjacent projects and infrastructure, but it's not setting off any alarm bells for us. Frankly, on the duration side, the thing that we're most concerned about is that we are exhibiting very little fiscal discipline in the U.S. government. That is not a political statement that's true across both Republican and Democratic administrations, and that the rest of the world is kind of waking up to this, and that this is not a great picture over the medium term. Frankly, if we think inflation is going to be a little spicier, and we think that we're likely to get no fiscal discipline in 2026, the likelihood that bond yields stay where they are or move a little bit higher, that we're not going to get a lot of juice, I think is quite high. We prefer to hedge our long equity position with more gold at this point.
Well, I wonder where credit fits in with this. And I'm saying this after Warner Brothers and Netflix, their tie-up has been confirmed this morning. That deal is expected to close in 12 to 18 months. Netflix has been talking about using a lot of cash as well as buying shares. That is code for debt markets that are going to be financing this since they don't have that cash on their balance sheets. At what point do you think that the credit market is going to experience some fatigue with the massive issuance it's seen, not only from AI, but from some of the other M&A activity that's come down the pipe?
Yeah, I mean, this is an excellent question, and actually something we've been spending a lot of time on our research side on this week, because we're asking ourselves, how much juice is there left in the credit market? We know spreads on the IG and the high yield side are close to the 15-year tights. It's great if you're a company that's issuing. It's not so great if you're looking for a great total return from that asset class. And as asset allocators, that's what we're really examining. So while I'm not calling for any significant spike in defaults, we have to ask ourselves, relative to equities, can we get the returns that we need on a risk-adjusted basis from credit at this point? And we're less convinced, and we've been a little bit underweight relative to our index.
So if you're underweight credit,
but overweight equity.
But overweight equities, and you're underweight long duration.
And balancing out with gold.
Mm-hmm. This is a new portfolio allocation. This looks like a different kind of model than, pre-pandemic, the 60-40 type of allocation.
It absolutely is. And a big project we're also undergoing is really kind of rethinking how we construct portfolios in general for all of our clients. They need to be outcomes-based and not just static based on a 60-40 benchmark. What part of the portfolio needs to be generating growth, income, and uncorrelated returns? And then where do the traditional asset classes and factor exposures fit into that? So this is a huge project for us, and we are really, really excited about where we'll take it.
Kate Moore, you're going to be sticking with us. Kate Moore of Citi Wealth here in New York, as we do see this deal. Netflix planning to buy Warner Brothers for $27.75 per share in cash and stock. We'll build on that in the upcoming minutes and hours. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Ivani Quinn. Ivani.
Yeah, well, just some more details on that. He didn't get to the $30 mark, Lisa, as you said. Netflix acquiring Warner Brothers, including its film and TV studios. The deal will be a cash and stock transaction valued at $27.75 per share of Warner Brothers Discovery. Now, the total enterprise value, approximately $82.7 billion. And that transaction expected to close after the separation of Discovery Global into a new publicly traded company. The Supreme Court clearing Texas to use a new Republican-drawn congressional map for next year's election. The decision reversing a lower court ruling, bolstering GOP hopes of picking up as many as 5 new House seats in the state. 3 liberal justices dissented, saying the majority should have respected the lower court's ruling. FIFA is conducting the Men's World Cup draw at the Kennedy Center in Washington today. The draw determines which opponents all 48 teams will eventually face in the initial group stage. The ceremonies kick off at noon. President Trump is hosting the festivities with performances from Andrea Bocelli and the Village People. The World Cup starts next June with matches in Canada, Mexico and the United States. And that's your Bloomberg Brief. Lisa.
What is it? Thank you so much, Vani. What is it? Is it the Village People? When Vani said the Village People, just laughter around the table.
Well, because it's a little bit unconventional, right? You have the Village People,
Bocelli.
YMCA coming out.
It was like contrast for me,
Aaron Judge will also be there.
Will he also be singing?
I don't think so.
Up next, we're not talking about that. All about affordability.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again. Affordability, they call it, was a con job by the Democrats. We did a great job on groceries and affordability. The only problem is the fake news.
Bloomberg's Lauren Dezensky joins us up next from New York. This is Bloomberg Surveillance.
Trying to build on 3 consecutive days of gains, equity futures higher in pre-market trading, led by actually the NASDAQ, which had been lagging behind for the previous few sessions, up at about 0.2% on the S&P. Range-bound on the euro-dollar cross. We had seen some dollar weakening that had reversed yesterday. Yields marginally higher. Watch this name. You can see Netflix shares lower in pre-market trading after announcing that they were going to buy Warner Brothers for $83 billion. It is a stock and cash transaction, raising questions about how much debt they're going to have to issue. We'll get into that in just a bit, but this deal seeming to culminate. Warner Brothers shares still halted after that news dropped. Under surveillance this morning, all about affordability.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again. Affordability, they call it, was a con job by the Democrats. We did a great job on groceries and affordability. The only problem is the fake news. There's this fake narrative that the Democrats talk about, affordability. They just say the word. It doesn't mean anything to anybody. Just about everything is down. You know, this whole thing is, they use the word affordability. It's a Democrat hoax.
Here's the latest. President Trump traveling to Pennsylvania on Tuesday to promote his economic agenda as more polls show affordability is the dominant concern for Americans. Bloomberg's Lauren Dezensky joins us now for more. Lauren, can you sort of square the circle for us? On one hand, the rhetoric coming from the White House is this is a hoax. On the other hand, the actions really speaking to the concerns making their way through polls about affordability.
Certainly. President Trump is going to Pennsylvania to pitch this affordability argument. I think that the president certainly, I think it stands to be seen what argument specifically he does make. If he tells those voters in Pennsylvania that this is all a hoax and prices are down, I don't think that that's going to resonate all that well. At the end of the day, data is showing that Americans are concerned with how expensive the cost of living has gotten in this country. And the idea that this is simply Joe Biden's problem or this is a hoax, this is Democrats coming after it, while it is a familiar refrain for this president, it's not necessarily something that is going to change the reality for Americans in that it's just more expensive to buy groceries.
Lauren Dezensky of Bloomberg, thank you so much, which is the reason why I think a lot of people in markets right now, Annmarie, have been looking to some sort of stimulus early next year. That maybe the rhetoric is one thing, but the actions are going to be quite different.
Well, there's really going to be a fiscal impulse when it comes to one big beautiful bill, some tax rebates. But then you have the administration teasing this idea of $2,000 checks. Now, the president continues to talk about it, even though we've seen the Treasury Secretary sort of back off and say potentially something we need to look at. This needs congressional approval. The president can't just come out and decide to write these checks. Also, we need to know what goes on with IEEPA before you start writing out dividend checks from the tariff revenue that these tariffs have brought in. Are they even legal?
Yeah, and we have to wait until bond vigilantes possibly wake up. Kate Moore of Citi Wealth is still with us. And Kate, I'd love your take on how you price in or game out any kind of fiscal support as you do see this affordability issue continuing to gain ground, not just with Republicans, but also the Democratic wing of the party.
Yeah, look, I think this is a major, major issue for most consumers. And one thing we've been anchored to, and of course we know we haven't gotten more recent inflation data from the government, but in the last print for CPI, more than a third of the components are running at a 5% annualized rate. And so there may be some things that are depressing overall headline CPI, and it could be rents, and it could be like one-time purchases like used cars, et cetera. But we know that the average consumer is going to the store and feeling like it's costing more to get the same basket of goods than it did a year ago. And that, to the point we were talking about the retailers, they're being more choiceful, they're being pickier about what they're buying, and they are really searching for value across online retailers and stuff as well. That's not behavior that's consistent with, hey, everything feels affordable to me right now. And I do think it's going to influence a lot of the discussion around the midterms next year, as well as some of the policy decisions from this administration going into that voting. So, President Trump may have said it's not a concern for him. I would suggest, given some rollback on some specific tariffs, he and his team are aware that it is an issue for many voters.
Especially the fact that he's going to Pennsylvania next week. He understands this is an issue. There's this meme circulating about the $2,000 checks. You have electrical power strip and you just plug it in itself. How circular is this when you basically have tariff revenue and then giving that revenue back? Isn't it just giving basically a tax credit back to the American people?
And the question I always have, because the administration has suggested if they were to do something like this, there would be a tiering system that certain consumers wouldn't qualify and others would. But if you have a higher propensity to consume with, say, the lowest quintile of household income and the highest, are spending quite a lot and they're feeling that tariff pain, who gets what and when and how would that be funded? It feels very challenging.
If it does only go to the lower income cohort, though,
yeah.
does that mean it could potentially put a lid on stoking inflation the way we saw some inflation induced under the Biden administration with the checks?
I mean, it's a good question. I think I haven't worked out the math there of what the real impact would be. But I do think that even if we roll back IEEPA, which I know we've talked about, and even if people feel temporary relief from some of the things that they purchase on a daily basis, the tariffs are a tool this administration feels are very important for trade partners and for, allies and adversaries alike. So I don't think we should expect tariffs to come off of the policy playbook for this administration, and that they will continue to pursue more specific sectoral tariffs that will be more enduring. And frankly, as we've seen in the past, have endured through multiple different administrations and different political leadership. So those things are stickier and will lead to prices. I can't tell you exactly what they're going to be at this point because we've heard many different stories. But I think tariffs are an important tool that are not going away.
This policy backdrop is the reason why a lot of people are really bullish on equities.
Yeah.
And I hear that again and again because ultimately, potentially, it could be inflationary, regardless of what happens if you're giving more cash to consumers. Also, there are these Trump savings accounts that are gaining steam. The idea of having every child in the United States that is eligible to have some sort of money set aside to go into equity markets or broad markets. How are you sort of pricing that in terms of the outperformance of the equity asset class as a whole, which tends to do better in more inflationary times?
Yeah, I mean, those are definitely supports for the equity market into 2026. But I would also note we have a very important driver, which is what's happening in terms of capital expenditure, not just in the AI space, but frankly, in a lot of adjacent spaces, and the overall kind of spending that businesses are doing to be competitive in this new and changing landscape. All of that data that we've received more recently, both from companies as well as things that are aggregated, are suggesting that spending goes full steam ahead into 2026. So combined with some of these policy, moves to get people invested in the market, the corporate side, I think, is really going to drive what will be a solid economy in 26.
Yeah, and I believe that your bank, Citigroup, just came out with an increase in their forecast for copper. I imagine copper very much gaining steam with all of the metals in general on the heels of that.
We've been looking very closely at resources, not just on the research side, but also in the Citi Wealth side as well, as beneficiaries, frankly, of this increased capital expenditure, and especially materials that do very well in an environment where we're building these data centers. So we see a lot of opportunity to actually add to resources, not just the tech companies, as a way to play this theme.
Kate Moore, wonderful to see you. Thank you so much for spending this morning with us. Kate Moore of Citi Wealth here in New York. Coming up the next hour, David Steinberg of Zeta Global with a fresh read on the U.S. consumer. Plus, Yahira Anand with your morning movers. Shares of Southwest Airlines lower after cutting its outlook. Annmarie, I'm watching Netflix shares right now and Warner Brothers. Warner Brothers actually restarted trade and is almost flat in pre-market activity. Seems like a big deal that a lot of people have been waiting for.
A lot of big deal. A lot of people have been waiting for this. It's been a bidding war. And for Netflix, this deal is the biggest ever they've taken on in scope. Shares are down. The next big hurdle is going to be the regulatory scrutiny this deal is going to come under.
Yeah, especially given the fact that there's a real focus on media and the potential groundwork for other big consolidation. Those shares lower by 2.7%. Netflix futures down as they do pledge to buy Warner Brothers for $83 billion. From New York, this is Bloomberg Surveillance. Futures inflecting higher as we look to close out the last day of the first week of December. I'll get it out. It is a long week, even though it is just the first one of the last month of the year. We're looking at a 0.2% gain on the S&P. The NASDAQ futures leading the charge, up 0.3%, and the Russell 2000, which hit an all-time high yesterday, is up 30% since April 30th. Now, those shares futures lower by about 0.1%. When you take a look at 2s, 10s, and 30s, 30-year bond yields rising to the highest level going back to September 25th. 4.78% rounded up. You're seeing 2 basis point increase there. Similar move on the 10-year, squarely through 4.11, with the real question around duration, given the fact that the Fed will probably cut rates and given the fact that some of the economic and corporate data has been better. 2 hours away from the cash open, let's take a look at some of those corporate stories. Yahaira Anand has them for us. Yahaira.
Hi, Lisa. It is a big shift in the media landscape. Netflix acquiring Warner Brothers Discovery studio and streaming businesses in an $83 billion deal, ending a saga that has been months in the making. The deal pushes Netflix deep into traditional Hollywood, overseeing a century-old studio and a theatrical business that Netflix has never really embraced. What also could be weighing on Netflix stock this morning, which is down 1%, is that $5 billion breakup fee if regulators reject the deal. Meanwhile, we are seeing Southwest Airlines shares falling nearly 1% in the pre-market, pairing earlier losses after the airline cut its profit outlook for the year. The carrier now expects operating profit of $500 million, down from as much as $800 million, blaming the hit on higher fuel costs and that recent government shutdown. It says that upended travel, and that is why Southwest is taking a bigger hit, since it is a mostly domestic airline. And we end on SoFi shares. They are falling nearly 7.5% in the pre-market after announcing a $1.5 billion share sale, which of course is a diluting event, but it follows a massive rally with SoFi's market cap nearly doubling this year. So it is striking while the iron is hot, planning to use those fresh funds to fund future growth. And analysts here at BI say that this could mean that it wouldn't be surprised to see SoFi pursue some M&A because of this move. Lisa.
Thank you so much, Yahaira. On our radar this morning, NAC Director Kevin Hassett saying the Federal Reserve should cut interest rates at its meeting next week.
We've got to get to a much lower rate. If there's consensus around 25 basis points, which it looks like there is, then I'll take it.
President Trump is planning to announce his pick to lead the Fed early in the new year, and Hassett is considered a frontrunner for the nomination. But still, Annmarie, a lot of questions given the fact that it's dragged on for so long.
It's dragged on, and the president said this week a potential Fed chair is in the room. Didn't really go out and enthusiastically talk about how he has made his decision on Kevin Hassett. Specifically, I know he's winning in the betting markets, but the timeline just keeps getting pushed back. And he's known potentially to change his mind. So it's not a done deal just yet.
And it really is this question of markets. How much of a concern is this? On one hand, you've gotten rumors and stories about pushback from members of the Treasury buying market. On the other hand, one thing Steve Englander of Standard Chartered points out this morning, you're not seeing those inflation worries perking up in break-even rates or other kind of market-based expectations.
Right, which Kevin Hassett then went on news and said, look, the market reacted fairly to the idea that the president has maybe not so much picked me. He wasn't trying to boost his own ego, but the idea that he's coming down to a decision. I do think it is interesting that the Treasury is trying to solicit input from bond investors. And if bond investors are telling them, yeah, that Financial Times article, one comment was, we don't want a Liz Truss moment. We don't want to get trust. That might give them pause. And obviously, the Treasury Secretary is going to have to be honest with the president in terms of what market participants are saying about the individual who's right now the front runner.
Yeah, Scott Besant's been very clear that the market ultimately does hold the vote. Right now, we're also watching U.S. Trade Representative Jamieson Greer saying the U.S. trade relationship with China needs to be stable, more balanced, and potentially smaller. Greer adding a 25% reduction in trade with Beijing would be a move in the, quote, right direction. Also talking about how negotiations and discussions are ongoing on a daily basis. So this isn't exactly something that is going quietly.
We had a détente between Xi Jinping and President Trump when they met in South Korea, but the trade negotiations continue and that dialogue continues. And there's been reports in the Financial Times that this administration is so focused to making sure that trade maintains on a good track with China because the United States need those rare earths, that they're actually starting to potentially look at ways maybe they could wait it out when it comes to other issues they have with China, like sanctions, when it comes to national security space.
Yeah, focus on natural resources very much front and center. Copper extending a record-breaking run after a bullish price outlook from Citi. Analysts expecting copper to rally to $13,000 by the second quarter. The AI build-out is fueling demand for the metal and stoking fears of a shortage. Let's turn back to that breaking news from earlier this hour. Netflix planning to acquire Warner Brothers Discovery in a massive cash and stock deal valued at nearly $83 billion, representing $27.75 per share. Joining us now for more is Geetha Ranganathan of Bloomberg Intelligence. Geetha, how surprised are you that this deal was announced so suddenly after so much drama over the past few months?
Yeah, we're actually very, very surprised, Lisa. We never saw Netflix really as a front runner. I mean, when we first heard the news about Netflix kind of kicking the tires, we just thought it was more of like an exercise, them just kind of looking at all of the assets. So this really comes as a surprise to us because I don't think anybody on the street or in the market actually thought that this was an existential deal for Netflix. It very much is the case for Paramount, Skydance, and Comcast. I mean, now those are two subscale streaming platforms. I think the street was very much looking at that as a must-have. Warner Brothers for Netflix, not so much. So definitely a huge surprise.
So why did Warner Brothers in the end go with Netflix?
So I think there are a couple of different things here. I think one is just the price is something that they were looking for. I don't think Paramount was willing to pay more than about $26 for the entire company. Remember, Warner Brothers here is selling two different parts of the company. So there is the global networks business, which is, TV networks, CNN and all of that. And then you have the streaming and the studio business, which is, of course, the far more valuable part of the business. And Netflix, of course, really kind of paying up almost $28 a share. So we know that David Zaslav, the CEO of Warner, was looking for something close to about $30 per share for the entire company. Remember, this is a stock that was trading at $12 just a few months ago. So there's been a huge run up. And I think that this probably was the best deal for shareholders. And that's what Zaslav said he was going to do.
Geetha, do you think that this is going to be the best deal for regulators? Do you think they're going to sign off?
Yeah, this is really a huge regulatory gamble, Lisa. I mean, you kind of look at Netflix, they already are the dominant streaming platform, 320 million subscribers globally. That's the number one streaming service. HBO Max also pretty massive with close to about 130 million. So you combine the number one, number three streaming services across the world, huge regulatory red flags. So it's going to be tough. There is a $5 billion breakup fee that kind of reflects that uncertainty. We'll have to see what are the concessions that Netflix is willing to give up.
Geetha Ranganathan, thank you so much for being with us. Hopefully we'll catch up with you again soon as we parse through the details. Turning to the broader economy, dated inflation data coming up as we get a mixed read on the consumer. A new report by Zeta Global, an AI-powered marketing cloud, finds, quote, holiday-related activity continues to support consumer sentiment, though growth appeared to be driven more by higher prices than rising volumes. David Steinberg, CEO and chair of Zeta Global, joins us now. David, this is the ultimate question. How much of what we're seeing that looks like strong sales really is strong inflation driving pretty tepid sales?
I think it's a combination of both. I mean, we're really seeing prices continue to go up. In certain categories, they are going down in some, like gas. But what we're seeing is really the economy is being driven by non-discretionary and holiday purchasing right now.
Which is the reason why I think people are looking at some of these mergers and some of these other activities in the market. The dominance of, say, the Walmarts, the dominance of the streaming services that can jack up prices in some of your streaming service. I mean, how much is that the gameplay right now? That there isn't that much growth, per se, organically, but some of the returns that we're seeing from corporations in the retail space have benefited from consolidating market share and actually doing better efficiencies.
I mean, there's no question efficiencies are getting done. I mean, we just had the holiday weekend. We saw our platform utilization go up 153% over 5 days. And AI was able to drop our clients' costs by 87%. That's not just us. We're seeing that across the board through mergers. And when you look at Netflix buying that type of a platform, I think they're looking for additional scale in a world where scale really is driving winning.
When you say dropping their cost by 87%, what type of costs are we talking about, David?
We're talking about the internal cost of managing their marketing and business intelligence. So getting rid of data scientists, getting rid of people who are focused on doing the activation of marketing, and quite frankly, lowering the marketing costs by hyper-targeting the marketing in a world like today where it's really a tale of two cities, where you've got the top 10% of people in the United States driving the vast majority of economic growth. You've got to be able to target them on a hyper basis. And once again, I think that's why you see the Walmarts, you see Netflix and other organizations are winning in the marketplace.
David, what you're saying is basically layoffs then.
Oh, there's no question that we're going to continue to see layoffs across the economy, in my opinion. AI is being talked about as a game changer. It really is. You're going to see disruption, too, for, I think, amongst the first time in areas of organizations that have just never been affected by this type of technology.
David, how does the consumer experience change? You talked about advertising being more targeted, how online purchases have increased dramatically. I just wonder how quickly consumers are adapting to a world that's rapidly shifting to a technology that not everybody has wrapped their heads around yet.
To put it in perspective, we saw almost a 300% increment in individuals utilizing artificial intelligence platforms to do their shopping at the beginning of this holiday season. So I think long term, you're going to have an AI agent that's going to represent you, and the organization that you're shopping with is going to have an AI agent that's going to represent them. And your agents are going to negotiate your price and help you figure out where you want to go and what you're going to do.
So do humans even matter, right? At a certain point, a robot's going to be buying dresses for one another. David, I'm just curious, going forward, at what point are we talking about a consumer that is strong or weak, or a consumer that's irrelevant because you've got bots speaking with each other?
Well, the consumer is going to be the ultimate purchaser. I think the AI is going to make recommendations to the consumer, and they're going to have to decide if they want to buy it or not. It's their money, so to speak. So I think you're going to see disruption, but the consumer, which in the United States makes up the vast majority of our GDP, is going to continue to be a very important component of purchasing for many, many years to come.
David, when it comes to the consumer, how much is the spending right now predicated off the fact that they know that they're going to get tax rebates next year?
Yeah, I mean, we're seeing tax rebates. We saw a meaningful reset, interestingly enough, from the reopening of the government. We saw the Zeta Economic Index tick down just a little bit after being up meaningfully the month before. And we think a lot of that came from the reset of everybody going back to work in government. And then you saw it going into the end of November, the holiday shopping season. We saw sales up as much as 4% across the economy. We think it's going to be a very strong holiday season, and we think people are excited that the government reopened. We think a lot of people are excited about tax rebates, and we think a lot of people are excited about where their dollars are coming from right now.
I'm so excited. I'll have your bot talk to my bot. Maybe they can figure something out. David Steinberg of Zeta Global, thank you so much for being with us this morning. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. A Virginia man has been charged with transporting explosive devices and attempting, quote, malicious destruction. Prosecutors claim Brian Cole Jr. placed pipe bombs outside Republican and Democratic National Committee headquarters in Washington on the eve of the January 6th, 2021 riot. U.S. Attorney General Pam Bondi says there could be more charges to come. Warner Brothers Discovery entering exclusive negotiations to sell its film and TV studios and HBO Max streaming service to Netflix. Sources are telling us here at Bloomberg the streaming giant is offering a $5 billion breakup fee if regulators don't approve the deal. The two companies could announce in the coming days. More Threads, a leading Chinese AI chip maker, jumped over 425% in its Shanghai trading debut. The move fueling optimism for China's goal of achieving tech self-sufficiency amidst trade tensions. More Threads was founded by a former NVIDIA executive. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vani. Up next, investing in AI power.
We're at the beginning of this technology build-out. AI is getting more compute intensive, but the bottom line is we need energy.
Abby Yoder of JP Morgan Private Bank joins us next as people look to natural gas, people look to copper and other resources in this build-out boom. This is Bloomberg Surveillance.
futures higher, looking to get a fifth day of gains. We're looking at a 0.2% gain on the S&P. Yields marginally higher as we do see potential expectations for a Fed rate cut leading to stronger growth next year, 4.11 on the 10-year. Take a look at the energy space. Crude prices are lower by 0.2% over this year. They have dramatically plunged. And this is sort of the conundrum. If you believe that this is an energy really intensive world, why is it that oil prices are down so much, down 17% year to date? Well, natural gas prices up significantly in the United States at record highs. They are up 42% year to date. It is all about which power source. Under surveillance this morning, investing in AI power.
Our energy efficiency improves by 5 times or 10 times each year. But the problem is this. We're at the beginning of this technology build-out. AI is getting more compute intensive. The adoption's going way up. I've got all these exponentials. And so we're going to keep chasing this. But the bottom line is we need energy.
Here's the latest. Investors piling into utilities as surging AI data center demand drives up power needs. Abby Yoder of JP Morgan Private Bank writing, we are still constructive on the market despite a strong year-to-date rally. Our favorite themes are AI power and defense. Abby joins us now. Abby, great to see you.
Great to see you.
So I'd love to talk about power and energy and what that means, given the fact that it's been a hugely diverging fate depending on which source of energy you're looking at.
Yeah, I know you just brought up oil prices, and I think, we were talking about this, like it really is a supply issue, right? Like you have too much supply on the market, they're incentivized, and now when you think about U.S. producers, they can break even at a lower price, right? So they can still continue to do this and be profitable. And when you think about oil, traditionally also, you have to think about what's going on in emerging markets and in particular in China, right? You have a slowing economy there, particularly on the consumption side. I mean, really on the investment side as well. So I think that's really weighing on it too. It's out, but then you look at things like nat gas, look at things like copper, and they're all doing really well because they will be part of this, power infrastructure build in the United States. And the way that we think about accessing that is really through utilities, right? Who are, and particularly the independent power producers who are signing these one-on-one contracts with the hyperscalers to secure that energy and that power demand off the grid, right? And so you're trying to avoid, which is becoming a political thing, trying to avoid the consumer price increase as well.
Okay, there's a lot to unpack here.
Yeah.
The idea that a lot of big tech providers are looking for energy sources outside of the grid so that they're not subjected to the political power so they can get the other extra energy. And it raises questions about whether we are seeing any of the overbuild in some of these areas, right? How do you discern whether you're pricing in true growth or whether you're pricing in something that's going to be a stranded asset in 2 years?
Well, I think that, when you think about the individual companies that are like, there's a particular nat gas company that is not willing to actually commit to a lot of these deals over a 5-year period because they want to avoid exactly that. So there is like a lot of prudent decision making, at least in our view, on the independent power producers who are saying, look, we're not going to do this if we think this is going to be a stranded asset. And that's part of why there's such a backlog, right? There's a decision making process that does feel very thorough in terms of thinking about, okay, we're going to add here, but we want to think about whether or not this will actually be a stranded asset in the longer term. And I would say also, when you think about the grid and how aged it is, particularly when you think about transmission lines being on average 25 years plus, if we have this build out and we have this upgrade to the grid, overall, that's a positive, right? Even if these become quote unquote stranded assets, if it's a data center, for example, if we get the upgrade to the grid that we've needed, but has been politically stagnant, that's a net positive, right, over the longer term. So I think
you mentioned this becoming a political problem, and it is. We saw that actually in the midterm elections in Virginia and also in New Jersey. If that's the case, do you expect government intervention in this space that you think is very bullish?
Well, I mean, you've heard inklings of it, right? And I think that the goal is obviously to avoid that. And I think next year will be very important when we think about, how these companies actually really construct these deals to make sure that doesn't happen. And it's very, power and power generation is very local, right? So it's very difficult to think that at the federal level they can have a meaningful impact in terms of that decision-making process. But I mean, it started coming up in conversations where I was like, this feels like it's going to be the next healthcare, right? Where it just becomes a very it's a lot of talk at the political level, but like how they address it will be very, I think, niche in terms of the locality.
If we don't see the build out and we don't see the electricity there, can the AI spending continue at this level?
No, I think that's the biggest risk. I truly think that when we think about going into 2026, and obviously that's a very bullish outcome for these utilities and the power providers, is that is the bottleneck, right? Especially in the United States. China's a different story. They actually do have that power capacity to be able to build. We just really don't. And that's the biggest thing. It's like, okay, they're signing all of these deals, but like, do they have the ability to actually deliver on it? Like, that's really, and I mean that on the power side. I don't mean that on the tech advancement and all of that. I think it's just, we don't have the grid to be able to support this, so we really need this build out to be across the entire grid, not just the data centers.
If your favorite trades are defensives, essentially, which is utilities and then defense stocks, right? I mean, that's a different kind of defensive. I'm just wondering what your view is then on how much the economy can meet expectations, right? Is this sort of an indictment of the idea that you're going to get some sort of massive reacceleration in the U.S. consumer?
Well, I think no. So we're not saying that we like being bullish on utilities, defense, and actually healthcare as well is actually not this defensive posture and negative outlook on the United States economy or markets. It's actually just structural growth drivers, right? Like you think about where policy money is going and where all of the spend is going. It's to power, it's going to defense, it's going to, tech, obviously, AI. And so that's kind of the part of the process that we're thinking. I know it kind of maybe screens at the high level as defensive in nature, but it's really more where are their structural growth stories, where are dollars flowing, and that really leads us to these industries and sectors.
Do you think that in general the way it will manifest is in this broadening out that we're seeing right now, or do you think that that's an oversimplification? It's just that the AI trade is broadening out, not that overall economic engine is really broadening out?
No, I do think that we'll see the overall economic engine broaden out. And I do think, look, inherently, we went from being overweight 3 sectors this year to being overweight 5. So that is suggestive of a broadening out, just generally speaking. And we do think that there'll be like a soft patch in the first half of the year. But this has been a very, very resilient economic backdrop and just corporate backdrop, right? We are at basically peak margins in 3Q earnings. And so they've navigated through what has been a very difficult tariff situation and political situation. And we really are of the view that we see another year of above average earnings growth next year for the S&P 500. And that's across a lot of different sectors.
Abby Yoder, great to see you. Thank you so much for being here. Abby Yoder of JP Morgan Private Bank, with that optimism continuing to build on the week. What we are seeing right now are deals and this idea of how much more do we see in the M&A space after the Netflix announcement to buy Warner Brothers.
Netflix announcement is going to be so interesting because there's been a lot of regulatory scrutiny already. And Variety had this exclusive reporting about prominent filmmakers writing to Congress saying you cannot let this deal go through. That's why maybe that $5 billion sweetener, if the deal doesn't get regulatory approval, was key to this.
Yeah, and we also see a $59 billion bridge loan that banks are agreeing to provide to Netflix for this deal. Netflix shares lower by 2.3% in pre-market trading. Coming up, Nadia Lovell of UBS, U.S. Interior Secretary Doug Burgum on that energy issue, Constance Hunter of the Economist Intelligence, and Michael Collins of PGIM Fixed Income.
We are still seeing that investors are sitting on the sidelines of this market.
There has been a shift in sentiment, and you're starting to see some deterioration in some of the key themes.
The equity market has to climb, basically, the traditional wall of worry.
You have an equity market that broadens and rotates a little bit.
As we think about next year, we do like equities. We do like U.S. equities in particular.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks inching back to record highs with optimism fueled by ongoing resilience among U.S. consumers. All eyes turning to next week's Fed rate decision as potential Fed Chair Kevin Hassett supports that 25 basis point rate cut and some dated inflation as well as consumer sentiment data coming up. Right now, though, the focus is squarely on the M&A space, with Netflix agreeing to buy Warner Brothers for almost $83 billion.
So this is going to be historic. This is the dominant streaming service going up against, or with now, one of the revered studios out of Hollywood, which is why there's going to be a lot of concern about the regulatory steps forward and the scrutiny this is going to come under. But also, it is pretty incredible that Netflix was this dark horse candidate. No one was taking it seriously. And then in the end, they were the ones that were able to get the deal done. And how quickly, we know they were going into exclusive talks just last night, but how quickly they were able to get to the finish line.
Yeah, and the financing behind it. I think a lot of people are looking for some of the details there, given the fact that the $83 billion almost will be paid for in stock and cash-free debt. And what we are getting is news this morning that Netflix has lined up a $59 billion bridge loan from banks across Wall Street, Wells Fargo, BNP, HSBC, et cetera, which would be one of the largest bridge loans in history at a time where there's huge regulatory risk for this deal.
Absolutely, which is probably why they had to put up that $5 billion that will be paid to Warner Brothers if this falls through. When you look at the bridge loan, Lisa, it is one of the biggest. Anheuser-Busch InBev obtained $75 billion of loans back in its acquisition of SAB Miller in 2015. So this is huge when you look at historical perspective.
Yeah, and going forward, this is really the backdrop for why it's such a complicated market heading into 2026. On one hand, you've got a Federal Reserve that is poised to cut rates. You have a consumer giving some mixed signals in terms of just how strong you are. And then you have capital markets that are revving up for another year of M&A, another year of relatively loose financing conditions. It is a difficult backdrop for the Fed when they meet next week, Wednesday.
Absolutely difficult backdrop. They're going to have a lot more data, but then the week after, they're going to get the most prime data they've been waiting for, which is the non-farm payrolls, which potentially means that could really give us insight into how the Fed is going to act in January. What Kelsey Barrow was saying, if we get that weak labor report on December 16th, does that mean we're going to get another Fed cut? Difficult moment for the Federal Reserve, especially uncertainty when it comes to things like IEEPA, tariffs. It is a midterm election year. So this administration is going to want to make sure they continue the consumer impulse in the United States. Will we get those $2,000 checks? What does this mean for inflation? It's going to be a little bit confusing.
Well, people keep buying. At least they keep buying stocks. Right now, equities across the board up, actually led by the NASDAQ. Right now, S&P futures up about 0.2%. Yields higher. And really watch this space as duration loses ground across the world this morning, 4.11% on that 10-year. And you are seeing just quiet in the currency space. Coming up this hour, as we do prepare to get that data, is PCE data. Nadia Lovell of UBS with stocks trading near all-time highs. U.S. Secretary of the Interior Doug Burgum discussing the future of AI energy production. And Michael Collins of PGIM Fixed Income looking ahead to next week's Fed decision. We begin this hour with stocks steady as traders bet that rate cuts will help drive a global rally into the year end. Nadia Lovell of UBS Global Wealth Management writing, "We think the outlook for stocks is positive as we move toward 2026. With broadening market performance, we expect the S&P 500 to hit 7,700 by the end of next year." Nadia joins us now. Nadia, good morning.
Good morning.
Great to see you. Thank you for being here. So how much is what you're expecting for next year predicated on the story that we've been hearing all morning, which is that earnings are doing pretty well and that companies have actually been maneuvering through a pretty difficult time with a stellar kind of performance?
That is core to our thesis. I mean, when we look at this past year, the fact that we had above trend economic growth, despite the fact that there was concerns around tariffs, next year we think that you're going to see very healthy growth as well on the macro level, probably something close to trend line 2%. And that could actually prove to be conservative. As you've been highlighting some of the things around the consumer into 2026, we also have stimulus coming from the One Big Beautiful Bill Act. That should also help. We also could see productivity gains, at least on the margin, as AI monetization starts to pick up. And then the M&A activity that we're seeing, all of this together should be able to drive some earnings growth of at least 10% next year. And we're going to see a broadening out of that. You know, historically, as you've seen in the last couple of years, a lot of it has been driven by the Mag 7. But we think that that gap is going to narrow next year. And so that's what we think that will push the S&P 500 up to 7,700.
We've seen the Russell 2000 in particular outperform as people bet on this broadening out, hitting a record yesterday. I just wonder how predicated that is on Fed rate cuts, right? Do you need to see substantial monetary policy easing in order to get the broadening out that so many people are betting on?
The broadening out that we're talking about is definitely within the large cap space across more sectors just beyond tech that has been driving this market. Can you see small cap get a bit of a big? Absolutely. But at the end of the day, small cap is more of a macro trade. So the economy is holding up and the Fed is cutting. That's usually a good environment for small cap. And also you're starting to see some recovery potentially in the manufacturing side of the economy that has been in a doldrums for the last few years. We know that small cap Russell 2000 is mostly exposed to financials, right? So if you're seeing pickup in M&A, if you're seeing better credit environment, the steepness of the curve as well, the short end coming down, that should be a positive from a financing cost for small cap companies. And so while we're neutral on small cap, you could see them get a bit more support in 2026.
Nadia, the way you're talking about 2026, it doesn't sound like the Fed even needs to cut interest rates, but you think they're going to continue?
We think that they will continue. We think that you get at least one more cut in the first quarter of next year. Right now, the market has really priced in the December cut. We've long been there, and the market has been swinging back and forth, rightfully so. We're not expecting any major changes in the S&P and the dot plot at this point. I mean, Powell probably still feel like he's in a data fog, so we don't expect any major changes in that. But maybe the S&P and the dot plots don't matter all that much for this meeting, because reality is, we don't have all the government data. We know that there's going to be changes at the Fed, but we think that you get one cut next year because of the in the first quarter of next year because of the softness in the labor market. And then the Fed will wait on hold and see how it goes. I mean, I think that the overall view is like the risk is probably skewed to more the dovish side for obvious reasons.
When it comes, well, to Michael Hartnett's point, though, if the Fed comes out and say the rhetoric is dovish alongside with the cut, will that signal that the Fed is more nervous about the economy than most other people are?
I don't think that Powell is going to be dovish in his rhetoric. And we think that this is probably going to be a hawkish cut, right? Again, the dispersion that you're seeing on the committee, Powell has to manage that when he messaged, in the press conference, just like he did in the last press conference. And so we think that the rhetoric from Powell will be very similar to what we heard in the October press conference, and a hawkish cut. Not looking for any sort of dovish commentary. Next year, we'll see. It all depends on who the chair is, but at the end of the day, the chair is one vote. It is a committee, but if the rhetoric around the chair is more dovish, that could also have implications for market. But we don't think that that's a negative, right? We think that this administration is going to do all that it needs to do ahead of midterms election. That word affordability keeps coming up.
Well, this is the reason why I think a lot of people are looking to possibly outside of the U.S. for an outperformance, right? And I wonder where you fall on that, because yes, a lot of people seem to agree that the S&P is going to do well in 2026, but on a risk-adjusted basis, a currency-adjusted basis, maybe not the outperformer.
I'm so glad you asked that question, Lisa, given my global title. But we like Japan. We like Europe as well, right? When you think about, I talked earlier about the potential for that cyclical recovery. We're already seeing elements of that in Europe. And so that should be positive. We know that Europe tends to be more cyclically focused. And also Europe does have those structural growth. Not as much as the U.S., of course, but data centers are being built out there. Electrification is happening. Longevity and healthcare is also happening in Europe. And so we think that that will help Europe. Defense spending, all of that should help Germany. And then Japan, we know that we're getting incremental information around stimulus for that economy that should help in 2026. And the companies there are also going through corporate reforms, and we should see a pickup in RREs. And then we were seeing upward revisions to earnings in Japan. So we think that that's also, look at Japan, has done really well the last several months, and we think that that continues in 26.
I wonder how complicated the backdrop is for you, given the fact that an increasing number of countries are choosing national champions. And we're seeing that over in the United States. We're seeing that over in China with some of the new AI startups that are gaining preeminence. How do you decide to play that? I mean, are you looking for who the national champs are going to be and getting behind them? Do you just try to steer clear of that kind of political interference?
No, we think that, look, this all goes back to the long saying of diversification, and that's becoming even more important as we go forward, as all of these governments support their economies more. China, I failed to mention, China is actually, and China Tech is one of our highest conviction ideas for next year, because the government is leading more and supporting its tech industry, and that localization of chip is happening. And we think that monetization potentially around AI happens faster in China than it is going to happen in the U.S., because China is really going after the consumer and applying a more lower cost model. And so I think that you have to sort of, have a diversified portfolio across all of these markets, because it's no longer that U.S. just lead and everyone else gets left behind. We think that the more boats are going to be rising.
Well, Nadia Lovell of UBS, thank you so much for being with us this morning. Nadia Lovell of UBS Global Wealth Management. And this is the reason why people were so interested, Annmarie, in more Threads technology. The IPO over in China that surged 425% in its debut. It was chosen as a national champion. China is looking to support some of its AI incubators, and this is a prime target.
Well, remember a few months ago, the administration said, fine, NVIDIA, you can sell your H20s to China. And China said, no. Sent out letters to a bunch of companies and firms, said, shrug these chips. We are going all in on our own, which is why there's been this huge debate within the administration. Do we have higher export controls, or do we get China and others addicted to our tech? That is a massive conversation and a massive debate, and they haven't truly decided just yet.
Yeah, we'll continue that conversation. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. National Economic Council Director Kevin Hassett said the Federal Reserve should cut interest rate at a meeting next week. Hassett expects the central bank to cut by 25 basis points and says he wants to, quote, get to a much lower rate over the long run. His comments coming as speculation grows that President Donald Trump is preparing to nominate him to lead the central bank. The European Commission fining Elon Musk's X nearly $140 million for violating the EU's content moderation law. It claims the social network misled users with its paid-for blue tick symbol and stonewalled researchers' access to data. It marks the first fine under the EU's Digital Services Act. X has 90 days to implement the changes, or it could face additional penalties. And it's official. Netflix is acquiring Warner Bros. Discovery in a deal valued at $82.7 billion. Netflix now becomes the owner of the HBO network, Warner Bros. Studios, film and TV archive. It's so far beaten out rival suitors Paramount, Skydance and Comcast. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, the morning calls. We're going to be taking a look also at that tie-up between Netflix and Warner Brothers and some of the debt financing behind it, a $59 billion bridge loan from Wall Street banks as Netflix tries to get through a lot of regulatory hurdles. That's next. This is Bloomberg Surveillance.
There's a lot of almost reflationary pro-cyclical tones starting to weave their way through the market's message here. And, you look out to 2026, and I think it tells us that really the tone is changing from, after years of all the excess liquidity being soaked up by the speculative economy, I think the excess liquidity is now being soaked up by the real economy moving forward. Very important theme for us into 26.
And into 26, that was Chris Verone of Strategas, a Baird company, talking as an increasing number of strategists get bullish on the prospect for U.S. equities right now, feeling that bullishness with futures up about 0.2%. You can see yields continuing to climb up about 2 basis points to 4.11%, and Brent is basically flat. When you take a look at natural gas prices, they have surged to the highest going back to 2022. They are higher by almost 4% this morning, with a real focus on just how much further they could go. It is snowing in Washington, D.C., so people are using their heat. Time now for the morning calls. First up, Truist raising its price target on Alphabet to $350, highlighting AI-driven efficiency gains and e-commerce momentum. Next up, Morgan Stanley upgrading MP Materials to overweight, believing it is positioned to benefit from U.S. rare earth policies. And finally, Needham initiating coverage of Oklo with a buy rating, citing its, quote, advantaged regulatory position in nuclear energy. Those shares lower by almost 4%. We do want to stick with energy. 28 Democratic California lawmakers writing a letter to the Trump administration condemning plans to boost oil drilling along the state's coastline. U.S. Interior Secretary Doug Burgum joins us now. Secretary Burgum, thank you so much for being with us. I want to start with just how important it is right now for the United States to increase energy supplies across the board, not just with drilling, but across the board in the face of the demand coming from AI.
Well, good morning, Lisa. Yes, it's absolutely essential, and this is part of the just announced national security plan that the White House has released. That security plan mentions energy 23 times. There's an entire section about energy dominance, and folks should think about energy dominance as the ability for the U.S. to sell energy to our friends and allies so they don't have to buy it from adversaries, particularly those adversaries that are either funding terrorism or are funding wars, actively funding war machines. And so it's core to the strategy right now, but it's also, as you've talked about on the show, is about with AI, because it never before in history have we been able to convert a kilowatt of electricity into intelligence. The demand for that, regardless of stock prices or stock movements, the demand for AI, for intelligence applied to every job, every company, every industry is going to continue to increase the demand for electricity around the world. The U.S. is an energy dominant country, now the largest oil producer in the world, largest LNG exporter in the world, and growing quickly. With that strategy, it bodes well for the future of the U.S., both in terms of peace and in terms of prosperity.
Secretary, I'm sure you're aware WTI is under $60 a barrel. What's the impetus for the oil and gas companies in the United States to continue drilling wells at this price level, which potentially could be a loss for them?
Well, I think one thing that we know that in the Trump administration, we're cutting red tape so rapidly. We think that one of the early targets we had was cut 10% of the cost away from those producers just by cutting red tape. So if you think about $60 today might be what $67 was a year ago because of our ability to take cost out for those producers. And there's example after example, whether it's from the EPA, the Department of Energy, Department of Interior, where we've been able to help reduce costs. And of course, this industry has been better than almost any in terms of gaining, productivity. The shale producers now drilling 3-mile laterals instead of 2-mile laterals, up to 4-mile laterals in many places. Offshore, we've seen examples overseas of people building 10-mile laterals when they're getting after the shale rock, all with the same small well pad on the surface. So, great for land management and great for energy production. And kudos to this industry. The entire shale revolution has occurred through innovation, and that innovation is going to continue. And with AI applied to that, it's going to get even better. So I see the leading companies are getting their costs down, even as demand is going up.
But Baker Hughes is talking about drilling rig activity has fallen 16% since Trump took office this year. The president loves to talk about drill, baby, drill. Do you expect that to change, those numbers to change next year?
Well, I think, again, I'd have to take a look at the numbers. When we talk about drilling activity in my home state of North Dakota, we had number of the well count was going down, but the miles of lateral productive rock could be going up. And so, analysts have got to make sure that they're actually keeping up with how fast this industry is changing, because we've got again, record production occurring right now, and we expect to see records through 2026.
One area where you have seen price increases has been natural gas. Natural gas prices rising to the highest levels in the U.S. going back to 2022. And a real question on how much the U.S. can continue to export to places like Europe in the face of significantly higher prices here in the United States. How do you plan to sort of set policies so that the U.S. can be a big exporter to places like Europe while not allowing prices to go up so significantly in the future?
Well, again, the key is its supply and its infrastructure. We have places in the U.S. right now where, again, there's not one price for gas in America, as you know. I mean, even though we've got the markets and we've got Henry Hub, but we've got widely ranging prices. I mean, even in the difference of price in Pennsylvania versus in New England, because of the lack of natural gas pipelines that have been blocked into places like New England. And when we think about markets, you're talking about AI and the capital spend going against AI, where we're an AI factory where we're actually creating and manufacturing intelligence. Those plants are going to go to the places where states have low electricity prices, and policies are setting price, not just markets. And we've got policies in blue states around our country. California, you mentioned California, 63% of California's oil is being imported from foreign countries because of blocking of pipelines coming into that state. They have a record number of internal combustion cars in California. They have more internal combustion cars than any other state has cars. and yet 2 refineries have announced that they're shutting down in California because of policies, not because of lack of demand, not because of lack of consumers. And so what's going to happen? You're going to have oil tankers and refined products coming into San Francisco Bay and coming into Long Beach in record numbers in California because of policies. They will have higher gas prices than virtually any other state. So again, we have a strategy in America to help every state. The Trump administration wants to have low, affordable energy prices for everybody, whether it's heating your home or driving your car or producing electricity for AI. But we're going to need the collaboration from states to make sure. And if states don't want to collaborate on that, then you're going to see this $1 trillion of AI, a historic amount of spend, all going towards states that have pro-energy policies that drive down prices.
Secretary, we've seen a significant increase in energy costs, especially for individuals who live near data centers. How is the U.S. going to do both at once, both support these AI initiatives, but also make sure consumers' energy prices remain affordable?
Well, if you said on the show, I mean, the prices are in electricity are local, not national. And so there are the examples that you think we're driving that analysis right now, and we're going to be publishing that from the White House to the National Energy Dominance Council, the Department of Energy doing great work on that. But a lot of the higher prices that you're seeing are not related to the AI data centers. A lot of the data centers are going to be off the grid, behind the meter, and then adding more energy, and then putting some of that energy onto the grid. So we could be actually increasing the supply in some of those areas where we've got increased pricing. It's because of the policies they pursued the last 5 years of having unreliable, intermittent, and highly subsidized projects, including things like offshore wind, where people were spending $11 billion to create 1 gigawatt of intermittent, versus spending $1 or $2 billion to create 1 gigawatt of assured 7 by 24-hour power. So the policy choices of the last 5 years, driven by sometimes climate extremists, were the ones that are driving up the prices that you're seeing. I mean, electricity costs 3 times as much in New England as it does in North Dakota. That is not because of data centers. That's because of policies.
U.S. Interior Secretary Doug Burgum, thank you so much. And definitely something that we would love to keep talking about, given the fact that a lot of people have talked about how certain places, I'm thinking of Arlington in particular, in Virginia, right near Washington, D.C., have seen higher prices for electricity bills due to artificial intelligence. Commentary somewhat different there.
Bloomberg ran an analysis that found that electricity now costs as much as, get this number, 267% more for a single month than it did 5 years ago in areas located near significant data center activity. I hear him. A lot of this is local, but also there's a tremendous amount of competition right now between the everyday user and the massive tech companies looking to build data centers.
Yeah. We're going to continue this conversation coming up. Constance Hunter of Economist Intelligence on what a Kevin Hassett-led Fed could mean for markets. Plus, Yahira Anand with your morning movers. Another check on Netflix and Warner Brothers. This is Bloomberg. Seeing a lift to end the week after a really interesting week, given the fact that we started on a pretty soggy note, and then it's been about 4 consecutive days of gains. Up now, fading a little bit from earlier, down up just about 0.1% on S&P futures. Seeing a little bit of euro strength, a little bit of dollar weakness, 116.49. Really, the question heading into next year is how much does this dollar weakness continue to mount that we have seen over the past week or two? And watching yields, they've come off some of the earlier highs, 4.11% rounded up. Take a look at these commodities. This, to me, is where the action is this morning. On one hand, you've got natural gas futures up 3.7% as people take a look at A, how cold it is, and B, how much they need to use energy in the face of all sorts of technological gains in copper. Those prices up 1.6% in pre-market trading. 1 hour away from the cash open, here is your morning movers with Yahira Anand. Yahira.
Hi, Lisa. It's a blockbuster deal that could reshape Hollywood. Netflix is taking over Warner Brothers Discovery's studio and streaming businesses in an $83 billion deal, wrapping up a dramatic saga that was months in the making. The deal pushes Netflix deep into traditional Hollywood, managing a 100-year-old studio and getting into the theatrical business, an area that has not fully embraced, and what also could be weighing on the stock, now extending its losses down 4.3%, is that sweetener, that $5 billion breakup fee if regulators don't approve the deal. Meanwhile, we are seeing Victoria's Secret shares surging 14% in the pre-market after the retailer raised its full-year outlook in a sign that the turnaround strategy is working at the company. But now that we've nearly wrapped up all the retail earnings, it's important to note the strength we've seen with Ulta, Macy's, American Eagle, Walmart. The list goes on, all posting upbeat numbers. And we end on HP not seeing the same luck, down nearly 10% in the pre-market after it delivered a softer than expected sales outlook, a blow to hopes that AI server demand would drive a bigger jump in revenue. And part of that weakness was due to order delays, with the CEO saying that big U.S. government and European deals slipped into 2026. That was due to a data center not being up and running and the U.S. government shutdown, which is getting a lot of blame this morning. Lisa?
Thank you so much, Yahaira, and wonderful work all week. And honestly, blame because maybe they deserve it. I mean, come on, some of this data coming out of Southwest, let's be honest.
And it's not Southwest's fault. What are some of these airlines supposed to do? The demand's not there because the government is shut down, longest in history, more than 40 days. And you can't make that up.
Which is the reason why we're seeing some revisions to full-year profit forecasts from the likes of Southwest. And we also heard a similar note from Delta. Let's turn to how the Fed's going to respond. NEC Director Kevin Hassett, seen as President Donald Trump's likely pick to be the next Fed chair. Constance Hunter of Economist Intelligence saying a Hassett-led Fed could go in multiple directions, writing, if the Hassett who wrote about the deleterious effects of inflation shows up at the Fed, the markets should feel relieved. If his loyalty to the president shows up, markets may show concerns. Constance joins us now. Constance, great to see you. Thank you so much for being here. Yeah. I want to start with why we haven't seen more concern in markets yet. Because ultimately, if you're looking to the market as a barometer of fear, you're not seeing any huge red flags.
No, you're seeing zero fear. And part of that could be that markets are looking sort of short term, right? They know that there's going to be another, or think that there's going to be another Fed rate cut in December. Also, it's the makeup of the Fed, right? The Fed was designed as an institution to be immune from political pressure. So whether you're talking about the terms of the governors, whether you're talking about the way the regional presidents are set up, so all of this is a very intricate timing game. I think the markets are betting on the fact that the Supreme Court will punt the decision to after February. And so therefore, Lisa Cook will remain in place, right? That's really critical because if you have a threshold of 5 or 4 governors, they can overrule the president's terms. So there's a lot going on in terms of timing. And I think the market is betting on a few things that will keep that independence in place, regardless of who is Fed chair. But also, if you look at Kevin Hassett's work, from before he joined the first Trump administration, it really centers on the importance of keeping inflation low because the tax code is geared towards benefiting firms during periods of low inflation. Right. So it depends on which Kevin Hassett shows up.
Yeah, it depends on which economy shows up too, right? Because ultimately you're at the behest of the market and of the economy. Right now we're kind of flying in the dark because we aren't getting a lot of real-time data. We should have just gotten the non-farm payrolls report. Sorry. Newsflash, we're not getting it until December 16th. But right now we are looking to September PCE report coming up in about 90 minutes time. I mean, what do they do with this? How do we understand whether inflation is the bigger problem or whether it's the labor market?
Well, we pretty much know what the PCE report is going to say with regard to inflation because a lot of that is derived from the CPI and the PPI. So we think it's about 2.9% for a headline, 0.22% for core. Those are both month-over-month numbers, right? The more interesting thing is going to be looking for any signals in the wage and income data. And so we are looking for a little bit of softness in the wage data, but that's going to give an indication of the strength of the labor market.
When you say which Kevin Hassett shows up, isn't he being chosen because the one that is going to be Donald Trump's chief marketer when it comes to the economy, isn't it going to be him that is going to listen to him when it comes to lower rates because that's the only reason why he's being chosen?
I don't think it's the only reason why he's being chosen. I mean, he is an economist who has a long track record of being in D.C., being a policymaker. He basically crafted the TCJA, and he was very influential in the CARES Act. So I think he's being chosen for those reasons. But remember, he's going to have to convince his fellow board members and the presidents who are going to be voting next year that that his policy direction is the direction that the Fed needs to go in. And that is a big question mark. I mean, he's going to have to use a framework, and he's going to have to think about policy within that framework. And keep in mind, we have the benefits of the One Big Beautiful Bill Act coming, the delayed tax refunds. We're looking for over 3% GDP growth in the first quarter, about 3% in the second, and about 3% in the third. How do you cut rates into that environment?
Do you think that potentially the rebates we're going to get, the One Big Beautiful Bill, and the fact that this administration is talking about $2,000 checks is going to make the inflation picture that much harder for the Fed next year?
Well, the $2,000 checks, I think we need to put aside, because who knows if they're going.
But they keep talking about it.
They do keep talking about it,
and it's a midterm election year.
Yes, fair enough. But yes, that would put more money in people's pockets, and it would be make them able to withstand price increases. Because I think what you've seen with the tariffs is a lot of concern about people's ability to handle price increases. Firms have absorbed some of that tariff increase. They've reduced hiring in order to sort of compensate for that. And so the question is, how much are they going to be able to pass on? It would stand to reason if people have more money in their pockets, companies are going to be able to pass on bigger price increases.
We're talking about a Federal Reserve that's set to ease policy, and we're talking about pain among the consumer base at the same time that Wall Street is talking about enthusiasm for mergers and acquisitions. We've been talking all morning about this deal of Netflix agreeing to buy Warner Brothers. We're talking about returns that are likely to be above 10% on the S&P next year. Is this a potential headwind or a tailwind for central bankers that are both looking for some sort of boost from consumption that will come with more of the wealth effect, but also could potentially be fueling froth in markets that seem pretty accommodative?
So it all comes down to productivity, right? If we really are getting the productivity gains, and not just from, when we say AI, right, it's not just generative AI and ChatGPT, but the productivity gains from just regular AI, right, are still being diffused throughout the economy. And that is an important driver of productivity growth. So it really comes down to, are we in a period of enhanced productivity growth? In which case the markets are not excessively frothy, in which case the Fed has a lot more room to maneuver, because ultimately that will help inflation. But there's going to be a lot of noise in the first and second quarter in the data. And it's going to be very difficult to interpret the underlying factors that are happening in the economy,
as opposed to the easy market that it's been to really decipher. Constance Hunter, thank you so much for being with us today. Constance Hunter of Economist Intelligence here in studio. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. The U.S. urging several countries in the European Union to block the EU's plan to use frozen Russian central bank assets to back a massive loan to Ukraine. According to European diplomats familiar with the matter, officials are arguing to member states that the assets are needed to help secure a peace deal between Kyiv and Moscow and should not be used to prolong the war. The U.S. Senate is seeking to ban NVIDIA from shipping advanced AI chips to China. They've introduced bipartisan legislation now to prevent the Trump administration from easing export controls. This all comes amid reports that the Trump administration had been considering relaxing restrictions on exports to China. The bill urges maintaining rather than loosening those export controls. FIFA conducting the Men's World Cup draw at the Kentucky Center in Washington today. The draw determines which opponents all 48 teams will eventually face in the initial group stage. The ceremonies kick off at noon. President Trump is hosting the festivities with performances from Andrea Bocelli and the Village People. The World Cup starts next June with matches in Canada, Mexico and the United States. And that is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. I would like to see Andrea Bocelli sing YMCA. I think that they should sort of bring it.
That is definitely not going to happen, but that would be funny. I have to say, though, I love Andrea Bocelli. I saw him recently at the Met. did some amazing Italian opera. He's performing also next week in New York.
The Village People should perform Italian opera, and I think that Andrea Bocelli should do YMCA.
YMCA, maybe he'll do the dance.
It would be a viral moment. Up next, setting you up for the day ahead. Plus, Michael Collins of PGIM Fixed Income looking ahead to next week's Fed decision and the glut of corporate debt issuance on the heels of all of the M&A activity. From New York, this is Bloomberg Surveillance.
The Fed is likely to deliver not just the December rate cut, but also one in January. But more importantly, just from a market probability perspective, I think that ahead of the jobs report on December 16th, which coincidentally comes after the Fed's decision, that you should be pricing in a probability for January that's really closer to 50-50.
That was Kelsey Barrow of JP Morgan Asset Management as people game out not just the Fed rate decision next week, but also heading into the new year, potentially with new leadership. Right now, you do have new leadership in the market. You have the NASDAQ outperforming once again. S&P futures are lower on the heels of some deals news, which we'll get into in just 1 second. Yields higher, almost to 412 on the 10-year yield rounded up. Otherwise, fluctuating around, trying to find some ground, and definitely some interesting action in the commodity space. The real move and the focus this morning has been on this Netflix deal, this agreement to buy Warner Brothers Discovery. Right now, you're seeing Netflix shares futures falling 4.2%. Warner Brothers Discovery shares surging almost 4%. A real question here about, A, the valuation. It would be a $72 billion equity value deal. It would be an $83 billion enterprise value of this deal, but also the financing of it. We will get into that in a second. Counting down to the opening bell, here is the trading diary for today into next week. 10 a.m. Eastern, September core PCE data, as well as University of Michigan sentiment. This is the data that we're getting because we're not getting non-farm payrolls. Not that I'm bitter. 3 p.m. Eastern, Trump signing executive orders. On Monday, Toll Brothers reporting earnings after the bell. Tuesday, we get that JOLTS job openings data. On Wednesday, an FOMC rate decision followed by Fed Chair Jerome Powell's press conference. Let's stick with the Fed ahead of next week's meeting. Michael Collins of PGIM Fixed Income joining us now for more. And Mike, I'd love to get your take on the Fed, and we'll get into, of course, the corporate debt issuance that we're seeing in the market. But starting on the Federal Reserve, I guess I'm trying to understand the market's reaction function to any of the data coming in real time. We're getting dated data. We're not going to be getting non-farm payrolls until after next week's Fed meeting. How do you sort of get a game plan to understand what the Fed's response mechanism is to a very uncertain backdrop?
Yeah, the good news is, Lisa, we're going to get a lot of data, right? I'm just looking at, today at 10 o'clock, we're getting hit with, a couple dozen data points, and we'll have a lot of that coming through over the next few weeks. It will be a lot for the market to digest. And I really do believe the reaction we've seen so far in the Treasury market, in Fed funds futures, have been driven by the data, right? I mean, all this talk about the politicization of the Fed and what that means for the shape of the curve. I really don't think there's been any notable market reaction to that at all yet. It's all driven by the data. And of course, some of the Fed speakers like Williams came out in the last few weeks really cementing the rate cut next week. But I mean, this is fun, right? This is what you do as a bond investor, as a market participant. You parse the data, you look at it, you overanalyze it, and you try to figure out the path of the economy, the path of inflation, the path of growth, the path of the labor market. I mean, the Fed is in the same boat as us, right? They're going to be seeing all this stale-ish data for the first time, and I think that there's a big question about what they're going to do next year. I mean, I think there's almost as good of a chance that they don't cut as they cut, 50, which is priced in.
Mike, this is exactly the point that a lot of people keep coming back to. Are we talking about a bond market that is embracing weakness that we're just not seeing? And are we seeing risk assets embrace the strength that the bond market isn't recognizing? How much are you looking to financial conditions? And I'm talking about some of the M&A activity. I'm talking about the glut of AI-related corporate debt issuance, and sort of give that as a read on just how accommodative or restrictive monetary policy actually is.
I mean, if you just think about it, Lisa, right? And if you're the Fed and you're looking at the inflation data, which arguably has been a little more benign, so maybe it's going to go from 3 to 2.5 over the next year. The growth data, the real data in the economy, seems to be really solid. And as you've heard, more people are kind of increasing their GDP forecast for next year, kind of from the ones to the twos, and even you hear some three handles. The labor market, is weakening, but it's resilient. Financial conditions are easy. I mean, the stock market is hitting new highs almost every day, and if you look at those projections you showed earlier in your show, the street is calling for somewhere between an 11 and 17% increase in the S&P 500 next year, right? It's like, wow, if you're the Fed, would you ever even think about cutting in that world, right? So you're really basing your assumption, if you're looking for cuts, and if you're the Fed planning to cut, that the labor market side really gets quite a bit weaker. I mean, we look at the economy, right? And it's kind of running on a two-legged stool, Lisa, right? You have this wealth effect, which is so powerful. It is sustainable, and it does have a drop-down effect, a trickle-down effect. And then you have the AI capex and all this technology investment, whether it's through borrowing or equity, market appreciation. Those two things are driving GDP. You take those two things away, Lisa, U.S. real GDP is close to zero, right? And you could argue the two legs of that stool are kind of two sides of the same coin, right? If the stock market tanks, the wealth effect gets hit. And so there is, the U.S. economy is on some, weak footing. So you could be in a situation at any point in the next 6 to 12 months where you do get a leg lower in the job market and in the economy. And in that case, the Fed's not going to cut twice, right? They'll probably cut 4 times. So that's kind of the market dilemma. The markets are pricing in 2. And, you could have this, downside scenario, which results in a lot more than that. Of course, as you mentioned, the upside risk is something we're spending a lot more time in our shop talking about, right? Where maybe the Fed cuts too much, i.e. you have a policy mistake. The curve does continue to steepen, which it has a lot. And financial conditions continue to ease and the stock market continues to boom. And that doesn't end well either, right? So these two big tail risks are generally bad over the intermediate term for risk assets, including our favorite, credit product.
Mike, just to get specific here, we are seeing a lot of debt, and you talked about the AI-related debt. We're seeing this morning this deal, Netflix agreeing to buy Warner Brothers Discovery for an equity valuation of $72 billion, a $59 billion bridge loan being offered up by a number of banks. Does this concern you? Does this feel a bit like the 2006, 2007 LBO booms that were really taking hold then? Or is this actually something that the credit markets can absorb?
M&A risk and deregulation are two big risks to the credit markets, right? Those behaviors tend to be late cycle-ish behaviors. They tend to lead to more speculative activity among corporate, CEOs and CFOs, more debt issuance, more leveraging up of corporate America. And I think we're kind of, in the middle innings of that part of the cycle. So yeah, it does worry. If you look at credit spreads this year, Lisa, they're basically exactly where they were a year ago or at the beginning of the year. They haven't really changed, meaning you've earned your carry or extra yield over treasuries, which is a good thing because we haven't had a lot of defaults. Credit quality is generally pretty good, but the supply wave in and of itself will put pressure on credit spreads. I mean, our base case is that spreads kind of leak a little wider and you maybe earn a little bit less than just your carry or extra spread next year. And a lot of that is supply driven, but some of it I think is just the increasing speculative behavior and speculative nature of a lot of this supply and corporate behavior.
So maybe more 2006 than 2007. Mike Collins of PGIM Fixed Income, thank you so much for being with us this morning. Let's stick with that big deal, Netflix acquiring Warner Brothers Discovery in a massive cash and equity deal. What we're seeing right now is Netflix shares lower by about 3.7%. Geeta Ranganathan of Bloomberg Intelligence joins us now. Geeta, you've had some time to look over how this deal is going to get financed, how this deal is going to get through. What's your sense of anything that stands out to you in terms of whether this has been something longstanding, whether this came together in a rush for Netflix to get this over the finish line?
Yeah, I mean, this is definitely a huge surprise, Lisa. I mean, we did not really expect Netflix to make this big, bold move. They've always historically stayed away from acquisitions of this type. And, they themselves have said many times that, M&A in the media space has kind of a choppy track record. So definitely something that we think they saw as a once in a generational opportunity. I mean, this is an iconic studio with very, very beloved franchises. And it's of course, it's a very expensive transaction, as you pointed out, $83 billion enterprise value. But again, it's for them, I think it's not just the cost of the deal, it's the cost of not doing the deal. And they're playing the long game here, just kind of a very defensive strategy for Netflix.
How difficult is the DOJ probe going to be and the antitrust concerns in Washington when it comes to this deal?
Yeah, it's definitely going to raise a lot of red flags. There's already been a lot of chatter about how this basically combines the number one streaming service in the world with over, 320 million subscribers, along with HBO Max, which has about 130 million, which is the number 3 service. So obviously, that there are going to be some concerns. Netflix is, however, kind of, I would say, flipping the script a little bit, saying that this is actually good for consumers. They're going to be able to offer both the services actually at a discount. So overall, it's actually going to be a good thing. But of course, we have to wait and watch, see how that plays out.
Geetha, just about a minute left. How much is this the path of travel? Everyone's going to try to consolidate as much share as possible and then say, look, you're getting a discount from buying both subscription services. You only get one for the increased price of just 10% more.
So historically, we've seen that bundles actually work really well, and they're not completely wrong when they say that it does provide good value to consumers. I mean, we've seen bundles from Netflix, from not from Netflix, but more from Disney, from other companies. Bundles are about 40 to 45% cheaper than if you were to buy the standalone products. So it does have some merit. But then again, we do see the costs of all of these services kind of constantly rising, and there is going to be a breaking point.
Geetha Ranganathan, thank you so much. I'm sure we'll be catching up with you as we get more details. A really interesting deal. AMH, I just wonder what other competitive impulse there's going to be in the media space to compete on this level, to really kind of do something similar.
Well, the appetite is there because Comcast and Paramount really wanted this deal, and there was a bidding war for it. Netflix sort of came out dark horse from behind. Not a lot of people were expecting this, as Geetha has been talking about. And I think given this deregulatory environment, the consolidation, we've already seen the media landscape, there's going to be a lot more. But it is not a done deal yet. Ton of regulatory scrutiny on this deal.
Yeah, Warner Brothers saying this in a filing just crossing. This decision reflects the realities of an industry undergoing generational change. So watch this space. Coming up on Monday, Christian Nolting of Deutsche Bank, Henry Detrays of Veda Partners, Kevin Foley of JP Morgan, and Savita Subramanian of Bank of America. From New York, this was Bloomberg Surveillance. Have a wonderful weekend.